Hello, friends. Welcome to the third and concluding part. Just a sec. Yeah, I think forgot to switch on my video. So, friends, welcome to the concluding part of this discussion. Just hold on one sec to ensure that everything is set up properly. Okay, guys. I think everything is set up, everything is proper, and we are good to go. So, without further delay, let's start off today's session. So, the thing is, in the previous two sessions, we did it in a different channel, the final channel. We thought that this particular session will do it in the our main channel, which is a very old channel actually. So we wanted to just see where we could actually reach more students. That's the only logic. There's nothing beyond that. Now, coming to the aspects on what we did in the previous session, what are we going to do in this session, so on and so forth. Previous two sessions, just to share with you the, what all we have done so far. In the first session, we did Forex, okay? Then we did derivatives. Then we also did interest rate risk management. We thought of doing risk management, but I said that, I've already done that as a full-fledged revision, so no need to do that. Then we started off on business valuation. On business valuation, we finished half. I think there were 10 to 12 questions. We solved 3 or 4 questions. Now we are starting off with we'll, complete the balance, I think 1, 2, 3, 4, about 6 or 7 questions are there. We'll finish off the balance, 6, 7 questions. Then we also have international financial management, startups, and M&A. So the way we'll work is we'll, pre-lunch session, that is till 1 o'clock, we'll finish the entire business valuation chapter. And if possible, start off on IFM and startups. We'll see whichever one is better, whichever one we can do, we will start off. And finally, we will do M&A. So we will do all the 4 chapters, business valuation, M&A, startup, and IFM today. But first, we'll complete business valuation, which was half done. We'll complete it fully. Then we'll finish startup and IFM. And towards the end, towards the later part of the day, we'll be doing the M&A, both the theory as well as practical aspects. And as I've been telling earlier also, it is very difficult to explain full-fledged theory in these short, revision or marathon sessions because the content is large. So, M&A theory alone is 3 hours. Startup chapter alone is about 3 to 4 hours, what I've taught in the full-fledged classes. So if in case you guys are interested, please enroll with us. If you have exams immediately in May, of course, then it is not much of use. But if you're writing in May, there is one particular course that we have, which we think will be of use to you, which will be our, AFM versus SFM course, where the differences between AFM and SFM, what are the incremental chapters that are covered in AFM versus SFM, which is the old syllabus. That aspect, if you're interested, please enroll with that. It's roughly about 20-25 hours. But the point there is that 20-25 hours, you can choose what you want. It is not really expensive also. It is fairly affordable. It is just about rupees 999, what you can see on screen. It is about 25-26 hours. It has the theory aspects as well as practical aspects of all incremental additional topics, subjects, videos, notes. Everything is available with respect to, the new topics that are added. So in case you're, planning to get a detailed understanding, my suggestion is go for this. Otherwise, of course, these revision or rather marathon classes are sufficient. But in marathon, I will genuinely not be able to do full justice despite my best attempts because there is always a time limitation. Okay, there's a limitation on me physically. There's a limitation on how much time you can spend, all of that. Right. So anyway, so moving back, let's get back to business valuation. I think last time we did question, if I'm not wrong, we solved questions. 4, 7, and 11. Now we'll go and get into question number 16. And please also note these, whatever I'm solving, the notes, the theory notes, incremental notes, everything is available as part of the description of this video. In the description, it is very clearly given where all these files can be downloaded. Please click on the links, download the files, and you can parallelly work along with me. Okay, chalo, no further time wastage. Let us get right into the topic. Question number 16, business valuation. This is, P590, page number 509. Okay. So, What is the question? Following is information available of Messrs. TS Limited. PBIT or EBIT, both of them are given. What both of them are the same thing, EBIT or PBIT. Then you have interest, PBT, tax, PAT, shares outstanding, EPS, and market price per share, as well as P ratio is given. In this, what are they asking? They have a undistributed reserves of 8 crores. The company requires 3 crores for the purpose of expansion, which is expected to earn the same rate of return as the capital employed at present. What is return on capital employed? ROCE. What is ROCE? EBIT by capital employed, return on capital employed. Now, some people will say this is into 1 minus tax or without 1 minus tax. You can take an assumption it is, they have not specified here whether it is post-tax or pre-tax. Typically, different people look at it differently, because if they're directly taking EBIT, some people say it should not be taxed, but some people take always everything should be post-tax. So you can take either assumption and solve. In exam, if they have not asked you to deduct specifically compute post-tax ROCE, I don't think you should do that. But again, it's your choice. Right. So what do we do here? However, if the debt to capital employed ratio is greater than 35%, then the P is expected to decline to 8 times, and the rise in the cost of additional debt will be 14%. And there will be additional cost which will be 14%. Currently, what is the debt cost? If you look here, what is the debt value here? They have said 10% interest, which is working to 1 crore. So the value of debt should be 1 crore by 10%, which is 1 crore by 10% is what? 10 CR. Right. So that should be the value of debt. Okay, not ROCE. Debt is 10 CR. Next, what are they saying? Given this, which of the following options the company would prefer and why? If the required amount is raised through debt, and if the required amount is raised through equity, and the new shares will be issued at a price of ₹25. So they're asking us to do compute using 2 options, debt as well as equity. Now, if you do this through debt, what is going to happen? If you do this through debt, first, as I said, compute existing debt. And please note all these questions, you have to put everything in a format. If you put it in a format, half the troubles are over, especially business valuation chapter, M&A chapter. Half the problem is in the format and putting the question on paper. Okay, whatever data they have given, just keep working downwards. I've said this multiple times. Just put everything in a format, you'll get the answer automatically. Okay, existing debt is 10. Then they've said you're supposed to find out in the first option, you're supposed to find out if you raise if you raise the capital that is required for expansion fully through debt. And you're supposed to find out what? Given the data, which of the following which of the following options would the company prefer? So if you raise additional amount through debt, then total debt will be 13 lakhs. Now, what is equity capital? That also they've given. How price per share is 75, EPS is 7.5, shares outstanding is 40 lakhs of ₹10 each. So 40 lakhs of 10 each basically makes 4 crores is the paid up capital. But they've also said undistributed reserves of 8. So paid up capital of 4 and reserves of 8, which basically makes the entire equity value as 12. What is current ROCE? EBIT by capital employed. What is capital employed? Capital employed is value of equity plus value of debt. What is value of equity plus debt? Existing debt is 10. Existing equity is 12. So 10 plus 12 is denominator, which is 22. And numerator, EBIT is 5. EBIT, they themselves have already given us 5. So existing ROCE is 22.73. Right. Now, what is the revised capital employed? If you raise the entire money through debt, the revised capital employed, your 3 crores of expansion money will go through debt, and your total debt will be 25, where your, the debt number, which was earlier 10, has now become 13. So the total denominator will be 25. What is the revised EBIT? Revised EBIT is, please note, they have said very clearly, let me clean this up. They have very clearly said 3 crores for the purpose of expansion, which is expected to earn the same rate of return in the capital employed as present. So on the new capital employed of 25, you will earn the same 22.73%. So your revised EBIT will be 5.68. So earlier, whatever was EBIT here was 5, which was 5, is now 5.68. Now, given this 5.68, what did they say? They said, if this debt, right? What is the specific wording they use? If debt to capital employed ratio is greater than 35, what is the debt to capital employed? You compute 13 by 25, which is 0.52. So it is greater than 35%. 0.52 is 52%, is greater than 35%. If it is greater than 35%, then cost of new debt will be 14%. So why is cost of new debt relevant? Because we have just found out the EBIT value. From EBIT value, you are also supposed to subtract the cost of debt. So existing debt, you already pay 1 crore, which is already given. And on the new 3 crores, you pay 14%. So 14% is 42 lakhs. So 1 crore plus 42 is 1.42. So from 5.68 EBIT, you subtract 1.42 crores, which basically makes your EBIT of 4.26 lakhs. From 4.26 lakhs, you again subtract tax. What is tax? They have given earlier the tax rate. What is the tax rate? Tax rate is 25. How did I get 25? Because they themselves are given tax rate as 25. Right. So you subtract 1.07 as tax, you get PAT, and this PAT you divide by the number of shares. There is no change in number of shares. There's only a change in debt. So share count is 40 lakhs. So you divide 3.19 crores by 40 lakhs, you get 7.99 as revised earnings per share. Now, this revised earnings per share, you are going to apply the PE as 8. Why are you going to apply the PE as 8? Because they have given that, where have they given? P ratio is 10 times, but if the capital employed is higher than 35%, PE ratio is expected to decline to 8 times. So if your capital employed is greater than 35, it is obviously 52%, your PE ratio falls to 8. So your share price is 63.93, approximately 63.64, but you'll say in your CA students, you have to say at least with 2 decimals rounded, 63.93. Now, if you raise the entire money through equity, the 3 crores you raise through equity, and the issue price is 25. Please note, issue price they've already given as 25. Where is it? New shares will be issued at a price of 25. So 3 crores into 25, 3 crores you'll raise at 25 rupees. If you're raising it at 25 rupees, how many shares will issue? You will issue 12 lakh. Where did I get this 12 lakh from? 3 crores. 3 crores is, or I'll write just 3 CR. 3 CR is the money required divided by 25 rupees, which makes it what? Which makes it 3 by 25 is 12 crores, right? This 12 crores, you have two parts. 12 crore shares into 10 rupees is face value. 12 crore shares into 15 rupees is your reserves. Okay. You may want to split it, not want to split it, but I'm generally telling you that number. Existing share capital is 4, which we already have. And this 10 lakhs, 10 rupees face value, it works to what? 2 by 5th of 12 crores. 2 by 5th of 12 crores is 2 by 5 only, 25 rupees. Yeah. So you take the revised share capital, you compute the number of, what is the face value of shares, what is the reserves, and then you add all of that to get revised equity. Even if you don't do this, it is not a problem because you've anyway raised 3 crores and existing share capital is how much? We have found out existing share capital. Where is this? Existing equity is 12. So 12, you add 3, you will get 15 as the revised equity. So what is debt to capital employed? Debt to capital employed is 10 by 10 plus 15, which is 40%. Is this greater than 35? Yes, it is greater than 35. But okay, so let us proceed. But why I said, but I'll help you understand. Now, EBIT is 5.68, which was original EBIT plus increase in ROCE due to new project coming in. Minus you have interest, old interest 1 crore. Then you get EBIT of 4.68. Then you subtract tax of 25%, 1.17. Then you get PAT. PAT of how much? 3.51. But please note, my dear friends, 3.51 PAT is for total share count. What is the share count? Earlier, you had how many shares? Earlier, you had 40 lakh shares. What is the new share count? New share count is 12 lakhs, right? You issued 12 lakh new shares. So you add 40 plus 12, which is 52 lakh. 40 lakhs plus 12 lakhs, you get 0.52 or 52 lakh shares. So you divide by 3.51 by 0.52. So you basically end up with EPS of 6.75. I think there's a rounding off error here as 0.53. It is actually 0.52 only. So don't bother about it. The numbers are correct. So 3.51 by 0.52, you get 6.575 as EPS. You multiply it by 8. Again, why are you multiplying it by 8? Because ROCE, not ROCE, debt to equity is less than sorry, is greater than 35%. So it is still at 40%. Even at this 40%, your PE is going to be 8. So 6.75 into 8, you basically get a share price of 54. Okay. Now, given that the share price is falling to INR 63.93 only in option 1 as compared to INR 54.02 in option 2, option 1 is preferred. Why are we saying this? Because currently the share price is given as 75. Because of this expansion project, even though you are generating ROE, the PE is falling because your debt is very, very high. Because the risk is high. Because if risk is high, then cost of capital is high, then your value of share will come down, which implied or justified value of your PE or justified PE number or implied PE number will come down. That is why your PE number is come down to it. So you have to specifically state that in this particular project, from current price of 75, it is falling to 63 or 54. Because it is falling to 63, this is the lower reduction. So we will go it at 63. Now, one thing I wanted to say, I said but somewhere in between. Why did I say but? Because if in case they ask you, what is the book value per share, or in case they ask you, things which revolve around what is the share count, what is the equity, what is the reserves, it is important to compute the equity, what is the amount that is coming through share capital form, how much is coming to premium form. But in this problem, there is no value add, but in certain problems, there may be a question which may be linked to it. So my suggestion always, if at all there is a working given, please try and work out and have that number aside. If it is not useful, it is not useful. But don't, later on, don't make a mistake of, array, I should have computed that, that would have made my life easy. So when you are doing the process, complete the full process and move forward. Okay, it'll take you hardly 30 seconds extra. Okay, so we've finished now question number 16. Then we're going to go to question number 18. Okay, so just give me 1 sec. A small water break. Yeah, so coming back again. Question number 18. What is this question number 18? This is again an RTP question, decent question. Sun Limited recently made a profit of 200 CR, okay, and paid out 80 crores, slightly higher than average paid in the industry to which it pertains. Paid out means here they are referring to dividend. Okay, profit of 200, and when you say profit, it is PAT only. Okay, average PE is 9. The estimated beta is 1.2. As per the balance sheet of Sun Limited, the shareholders' funds is 450 crores and number of shares is 10 crores. In case the company is liquidated, building would fetch 200 crore more than the book value and stock would realize 50 crore less. The other data of the industry is as follows. Projected growth rate, dividend growth is 4%, risk-free rate of return is 6%, market rate of return is 11%. You are required to value the company using PE ratio, dividend growth model, book value, and net realizable value. These kind of questions have been asked in the exams earlier as well. So, which is why I wanted to solve this. Now, what have they given? Net profit 200. First, write down the data. Right, dividend paid 80. Okay, then what is the PE ratio? PE ratio is 9. So if PE ratio is 9 and net profit is 200, what is the value of the company? This is what market cap, value of value. So when you write here, no, you have to value in rupees crore, equity. Okay, you should write the word equity or market cap is 1800 crores. The number of shares is how much? 10 CR, right? They've said, where is this? Number of shares is 10 CR. So 1800 by 10 CR is 180. Now you can work other way also. PAT of 200 divide by 10, which is basically 20. This 20 you multiply by 9 P ratio, you get 180. That is also perfectly fine. But whatever data is given, just proceed with it. Now they're asking us to first value as per P ratio. So we already valued, no? It is over. First part of the question is already solved. Second part of the question, dividend growth model. For dividend growth model, what do you need? You need cost of equity, you need dividends, you need dividend growth rates, then you can actually compute. So let us see what is the dividend growth model. What is the cost of equity? Cost of equity is RF plus market risk premium to beta. What have they given RF? Risk-free rate is 6%, market return is 11%, and beta somewhere they mentioned. Where did they mention beta? Here, they mentioned beta here as 1.2. So you use that and compute the cost of equity. 6 plus 12 into 11 minus 6. 6 plus 1.2 into 11 minus 6, which is basically 12%. right? So cost of equity is 12%. And what is the dividend? Dividend, they themselves said, first line of the question is paid higher than average industry average of 80. Then what is D1? They said here projected dividend growth rate is 4%. They have not said whether it is permanent, it is first year, second year. So you always make an assumption if only one dividend growth rate is given, that it is forever, right? So D1 is what? 80 into 1.04, which basically is 83.2. What is the value using dividend growth model? Very, very simple. D1 by KE minus G. So 83.2 divided by 12%, which is the cost of equity we found out, and 4% is the growth rate. So you find out 1040. So value per share. Now, please note one thing. Dividend, what we paid is, you can either compute on total dividend paid or you can compute dividend per share. Here I computed on total dividend per share, which is why I divide by the number of shares. Or you can directly compute dividend is equal to 80 CR. Share count is 10 CR. So DPS is 8. If you compute on 8, the value will directly be 104. So please don't forget that. If you are computing directly with 80 crores, you have to divide by the number of shares. If you're computing based on DPS, you can directly get the value per share. Next, what is book value? Equity value, they themselves are given as 450. See, this is a very easy question. Okay, I think it's asked once, some said is full task kind of a question. No, typically our institute questions of late are very, very complicated and convoluted. This is a very, very easy and full task question. Now, book value, shareholders funds is 450, and building will get 200 extra and stock will be 50 less. So 450 plus 200 minus 50, which is 600. 600 by 10 crore shares is basically your 60 rupees. That is the book value per share. And then what is it that they have said? Summarize. That's all. Book value. No, that is not book value. That is net realizable value. My mistake. Net realizable value. Net realizable value is 60 per share. Book value is here. 450 is the value of equity divided by 10 CR, which is 45. So book value is 45. So you put all of them together. 180, 104, 45, and 60, right? And you necessarily please summarize in a table. When you're asked questions like this, especially when they're asking you to value on 4 types, 5 types, if you put a summary for evaluator, please do this for evaluator's sake, not for and probably even for your sake, so that you summarize everything in one place. You're very clear what you have solved. Okay, this is an easy question. I think it's a full task question, a very unlikely you'll get, but it will solve some of the doubts that you might have. Next, question number 20. This should be a good question. Equity of KGF is 410 crores. Okay, equity of KGF is 410 crores. Debt is 170 crores. So total put together is 580. Printers division segment value is 74% and has an asset beta of 1.45. Balance sheet value is applied on spares and balance value is applied on spares and consumable division, which has an asset beta of 1.2. So you have basically 2 divisions. Both of them contribute certain percentage of value. One is 74, so obviously the other is 26. And both of them have different asset betas. Please do not forget the formula for asset beta. Asset beta is equal to, we'll see the formula. Okay, it is there. If you want, I will show that also. Where is it? Yeah. Weight of debt into beta of debt plus weight of equity into beta of equity, not cost of equity. Beta of equity. Okay. This is the one. What else have they given? They have given, you are required to calculate equity beta, very simple. Ascertain equity beta if KGF Limited decides to change its debt position by raising further debt and buying back equity to have its debt to equity ratio at 1.9, assuming that the present debt beta is 0.35, further funds raised will have a beta of higher. Oh, there's a lot of stuff. We'll come back to second question. But first, I want to show you that formula, guys. Okay, and I want to explain why I want to show that formula and do it is, there's a formula sheet. Here. See, this is the formula. Beta of assets is equal to beta of equity into equity by equity plus debt into 1 minus T. In this question, we have not been given tax rate. If tax rate were given, you have to necessarily apply this. And beta of debt, typically beta of debt is 0. So the second portion, this portion typically becomes 0. But in our question, the question that we're trying to solve, they gave you the value of beta of debt. Okay. Typically in market, the debt does not have beta. It does not have beta, but if at all they give you any value, please consider that. If they give you a tax rate, you have to consider that. Please don't forget this formula. In the question that we are solving, tax rate is not given, but beta of debt is given. In most of the questions, they will say beta of debt is 0. They will not give debt beta and they'll give tax rate. Okay. In our case, ulta has happened. Okay. That is why I specifically wanted to show you. Now, coming back to our question. We'll do solve the second part next because there's too much of information. We'll come back first, find out the equity beta, and then we'll come back. Now, printer is 74%, spares is 26%, right? And beta, they themselves have given 1.4 and 1.2. Where is this? Asset beta is 1.45 and asset beta of 1.2. So you find out the weighted average asset beta. Find out the weighted average asset beta, which is what? 0.74 into 1.45, 0.26 into 1.2, you'll basically get 1.385. Now, this 1.385 is asset beta. And asset beta, in that particular formula, if you see, asset beta is a combination of equity beta and debt beta. They've given total asset is 580. 410 plus 170. So 410 and 170, you are now required to find out equity beta. So equity beta is the balancing figure. Okay. So debt beta of 170, okay, which has a weightage of 29%. How did I get 29? 170 by 580. 170 divided by 580 is 29.31% or 29. I took a rounded off number. You take 29.31 also is fine. That, and they've given the beta value. What is the beta value? Debt beta they gave us 0.24. And asset beta of both individual divisions has been given. So you first using individual betas, you find out the overall asset beta. Put the overall asset beta and you subtract the values pertaining to the debt beta, you will get the value of equity beta. Right? Equity beta you'll get as 1.8598. This is the average computation. You can also do it very simply. Weight of debt into beta of debt plus weight of equity into beta of equity is equal to total asset beta. So 1.3585 is equal to this formula. And you solve for beta of equity, you get 1.8598. So this is the answer to the first question, which is what is the beta of equity? Next, moving forward. Now, second part of the question, which is what? Which is the more complicated, convoluted, whatever, additional, too much of gyan they've given, which is ascertain equity beta. Okay, you have to again find out equity beta. If they decide to change the debt equity pattern by raising debt and buying back equity. So now you are raising debt and buying back equity. So you borrow money to buy off equity such that your DE is 1.9. So this is the first question. So currently you have 170 and 410, which is 580. The same 580, you will split it as 1.9 is to 1. Okay, 580 divided by 2.9, basically 200. So 200 into 1.9. So you'll basically have 380 of debt and 200 of equity. So you'll have to buy back equity of 210. How did I compute all of this? Very simple. D plus E is equal to 580. D by E is equal to 1.9 by 1. This implies D plus E is equal to 2.9. So D plus E ratio is equal to 2.9. So equity is equal to 1 by 2.9 into 580, which basically will give you 200 CR. If equity is 200 CR, then debt is 380 CR. And if equity is 200 CR, the current equity is 410 and you subtract 200. So you're going to buy back 210 crores of equity. So that is for the first working that you'll do. See, 580, 1.9 is to 1. You get debt as 380. Existing debt is 170. So you'll take new debt of 210. You'll buy back equity of 210. Right? So balance equity is 200. This is the first working that you have to do. Second working is what? Assume that the present debt beta is 0.35. So here we assume debt beta of 0.24. Ignore that. And instead assume it as 0.35. And the funds raised by debt will have a beta of 0.4. So current debt ka beta is 0.35. New debt beta is 0.4. So total asset we already found out, which is what? 1.385, right? So in all these, please note the total asset beta will not change. Debt beta they've already given. So what will change is only equity beta. So total asset beta is 1.35 into 580. You get some value, beta into value. Old debt was how much? We originally had debt of 170. New debt is how much? 210. So this old debt will have a beta of 0.35. New debt will have a beta of 0.4. So you multiply these two numbers, you get this and find out the difference. You'll get a value of 659. This 659 is the beta into value product For how much value of equity? 200. So you work backwards. 659 by 200, you'll arrive at 3.299. So beta will be 3.299. Because you have increased the debt portion, the company's earnings have become more sensitive because one thought there is risk is increased. Second, if there is any profit, the profit will directly flow to the very, very few equity shareholders. So the equity shareholders' cash flows have become very sensitive. So if there is a loss, they'll actually bear a big loss. Why? Because most of the money is taken away by the debt holders, which is why your beta has increased. Now, what is the last question that they ask? Whether the new equity beta justifies increase in the value of equity in account of leverage. So what are they saying? They are saying that the beta has increased. Does it justify, the value of increase in value of equity? Yes, the equity beta has increased as value of debt has increased, which has led to an increase in risk, and hence the equity beta is high. If equity beta is high, then obviously your, the risk-free, the cost of capital will increase, and which will have again consequences like what we saw in the previous question. So you have to specifically answer yes. Whether new equity beta is justified. Yes, it justifies the increase in value of equity on account of leverage because the leverage has increased. There is greater sensitivity of the cash flows, which increase the beta value, which increases the cost of equity. Okay, so given that increase in cost of equity, there will be changes in the share price, so on and so forth when you compute. Okay, you have to say that. Given that increase in cost of equity, there will be a change in the share price, whether you calculate it by P method or whether you calculate it by discounted cash flow method, whatever the method that is. Okay, those methods are not given, so we'll ignore that, but we'll just say that there will be a change in the value. Right now, what is the next question? We finished question 20. Now we want to go to question number 22. So see, in this thing, I am trying to teach you concepts along with problems rather than blindly solving problems. Because if I teach just concepts, it gets very boring. Okay, not everybody appreciates it. Along with the problem, when you solve both concepts as well as questions get solved, which is why I'm trying this. But let's see. We'll take feedback from you. Any of you have feedback, please share it with us in the comments or share it with us at support@indigolearn.com or post it in forums. We'll be more than happy to make changes, and try and do what suits you more than trying to do something which may not suit you. Okay, so moving forward, illustration 22. Intel Limited, promoted by transnational company, is listed on a stock exchange holding 80%. So Intel Limited is the subsidiary, promoter is transnational company. Intel Limited share count, transnational company has 80% stake. The value of the floating stock is 45 crores. So 20% is free float. What is free float? Total share, 100% of the number of shares minus the percentage of share held by a promoter or a holding company or anybody, which is, that particular shares, in this case, 80%, no, that will never come into the market, right? People won't trade in it. So the balance amount on which trading happens in the market is called free float, which is 20%. So 20% is worth 45 crores. So how much is 100% worth? 45 into 5, which is 225 crores, right? The market price per share is 150. The share total market cap, what is total market cap? Total share count into share price is 225 crores. We already found out. But market price is 150. So 225 by 150, 225 crores divided by 150, you will get number of shares, I think, as 1.5 crores. We will see. Capitalization rate is 20%. If capitalization rate is 20%, then what is the EPS? The share count, you can work at the EPS. From EPS, you can, you can basically find out how the share price has been eroded. We'll see that. We'll see all of that. The promoter holding is to be restricted to 75%. So promoter holding has to come down from 80 to 75. As per the norms of listing agreement, the board of directors have decided to fall in line to restrict promoters holding to 75. Yes, by issuing bonus shares to minority holders. So this kind of thing has happened in real life also. It has happened in 2008 or 9, I think 2008, when Reliance Power did an IPO, the share price crashed immediately after listing. So the company gave a bonus issue only to the retail shareholders. So such kind of bonus issues can be given specifically to certain shareholders. It is possible while maintaining the same PE. Okay. So now you are required to calculate the bonus ratio, market price after the issue of bonus shares, and free float market cap after issue of bonus shares. Very good question. I like this question. So let us see, 80%, 20%, 45. I already told you 45 is the free float. So total market cap is 225. And current market price is 150. So share count is 225 by 150, which is 1.5 crores. Then current market price is 150, capital gain rate is 20%. So that means that EPS is 30%. Why is EPS 30%? Because EPS divided by capitalization rate will give you market price. So 30 by 0.2 will basically give you 150. So 150 into 0.2 will give you 30. So you found it out. What is profit after tax? EPS into number of shares. What is EPS? 30 into number of shares is 1.5, which is basically 45. Right? Which is 45. Then what else can we do? Yes, let's move forward. P ratio. What is current market price? Current market price already they've given us 150. What is the P earnings? Earnings is 30. So P ratio is 5. Now, what are they saying? Why are we found out P ratio? Because they said while maintaining same PE. So they have to maintain the same PE. So new shares issued, let it be X. Okay. Existing share of minority is how much? 1.5 crores into 20%. 1.5 is the share count into 20%, which is 30 lakhs, right? 30 lakhs plus X, you will issue such shares such that the new share count is 25%. So you're basically equating 25% is equal to share count of minority, which is old 0.3 plus new share of X by total share count, which is 1.5 plus new share issued of X. So you solve this equation, you will get the share count issued of 10 lakhs. Now, this 10 lakhs is issued to how many? 30 lakh shareholders, you're issuing 10. So, for 1 for every 3 held by minority. So, bonus ratio is 1:3. Is that the first question? Yes. What is the bonus ratio? Now, they're asking market price after issue of bonus shares. What is the market price? PAT is 45. So, new share count. PAT will not change. No? Just because you have change your shareholding pattern, PAT will not change. 45 CR. Where did we get 45? We have already computed here. They themselves, no, they have given or we have computed. Where is it? Here. We have computed here. We have computed it here. Right. So 45 is the PAT. You divide that by the share count, new share count, 1.5 plus 0.1 is 1.6. So you get the EPS as 28.125. Now, this is where the maintaining same PE, this number 5 comes here. So you multiply 28 into 5, you get 140. Hare Baba, the share price has come down. Yes, share price has come down. Why has it come down? Because you have allotted some shares free to somebody. So obviously share count will increase, EPS will remain the same. So obviously the share price will come down. Share price was what earlier? We computed it as 150. It has come down to 148. That is the second question. MPS of issue of bonus, MPS after issue of bonus. Then what is the free float market cap after issue of bonus shares? What is free float market cap? Number of shares that of the minority shareholders multiplied by the share price, you get 56.25 CR. Very simple question, but you have to understand the logic of what they're asking. Okay, we have now finished question number 22 as well. We have 3 more questions, 29, 33, and 35. Right, 29. This is again an interesting question. Compute EVA of A Limited with following information. They've given P&L, revenue, direct cost, SG&A, EBIT, interest, EBT, tax, EAT. EAT or PAT both are same. You can call it EBIT or PBIT, doesn't matter. Balance sheet, you have plant property equipment of 1,000, current assets is 300. When they give current assets, assume if they've not given non-current current liabilities, assume this is net current assets. Okay. Then you have equity, which is total is 1,300. Equity is 700, reserves is 100. Non-current liability is 100. The current, they've given current liability, so we shouldn't do that. Current liabilities and provision is 400. So total again adds to 1,300. Assume bad debt provision of 20 lakhs is included in SG&A and the same amount is reduced from trade receivables and current assets. Okay. Then assume that the pre-tax cost of debt is 12% and tax rate is 30% and cost of equity is 8.45%. So in this question, there is one very, very specific reason why I want to consider, why I want to do this question. See, they don't say whether this 20 lakhs is pre-tax or post-tax. See, provision, when you say provision, when you say something is included, so I say my PAT is 100. This PAT also includes 20 lakhs of provision. PAT is profit after tax. So the provision that they've given, is it pre-tax or post-tax? Ideally, the institution should be clear, but unfortunately, they're not. So in most of my questions, I have done both things. That is, assume it is pre-tax, assume it is post-tax, work parallelly in 2 columns. Okay. Assumption number 1, provision is provision is pre-tax. Okay, what is it that they want to find out? They want us to find out the EVA, no? Okay, so they want to find out the EVA. What is EVA? EVA formula is no PAT into 1 minus tax rate minus capital charge. What is capital charge? Back into invested capital. What is invested capital? Your whatever is the value of your debt plus equity, right? EBIT. What is EBIT? EBIT they've already given us 410. So 410. And this is pre-tax provision. So if it is pre-tax provision, you have to directly subtract it from EBIT. If it is post-tax provision, then you subtract it from the PAT, right? So 400. And one more thing, in these kind of questions, no, are you required to subtract or add provision for doubtful debts? You are required to add back. Why are we adding back? Because it is a non-cash charge. Because it is a non-cash charge. So you don't subtract, you add back. So you add back 410 plus 20, you get 430. And existing PBT and tax expense, if you compute the tax rate, you get as 30%. So you apply the same 30% on 430. So you get 301 as the no PAT into 1 minus tax rate. No PAT is basically EBIT, net operating profit after tax, right? Which is basically no PAT, that is equal to EBIT into 1 minus tax rate. Now, what is WACC? WACC, have they given any numbers? Yes, pre-tax cost of debt is 12%, tax rate is 30%, and cost of equity is 8.45. So you can directly compute 12 into 1 minus 0.3. 12 into 1 minus 0.3, basically 8.45. Post-tax cost of debt is 8.45, cost of equity is 8.4 and 8.45. Then what is the equity plus reserves and non-current borrowing here? Equity plus reserves and non-current borrowing. So you don't take this current liabilities and provision as part of invested capital, which is why I said equity plus debt borrowings. Right. So you take equity as 800, non-current borrowing as 100, total as 900. And what? This adjustment of 20 also has an impact on your equity value. So this 20 is a pre-tax provision. Post-tax provision is how much? 20 into 1 minus 0.3, which is 0.7 into 20 is 14. So this, if you're adding back something to NOPAT, then you also have to add back the same amount to your reserves, right? So you take the reserves, you add the reserve to the reserves, you add 14. So your total invested capital is 914. So total is 914, of which equity is 814 and debt is 100. Now, why are we acting back to equity? Because when you subtract a provision, the PAT, whatever you get, goes and gets added to reserves, right? You're at CFI level, so I'm pretty sure you understood this part, right? So when it gets added to reserves, which is why you're changing the reserve value, which is what gets reflected in the value of equity. Now, cost of equity is 8.45, cost of debt is 8.4. You compute the WACC, you will get 8.44. Okay. WACC is 8.44, right? Yeah, WACC is 8.44. Right, 814 into 8.45 plus 100 into 8.4, whole thing divided by 914. Right. Now, what is capital charge? Capital charge is WACC into adjusted invested capital. So 914 into 8.44 gives you 77.18. 77.18 is your what? Capital charge. So what if that is a capital charge? What is the EVA? EVA is no PAT minus capital charge. This should be not 1 minus tax rate, because no PAT is already after tax. Okay, it is EBIT into 1 minus tax rate or no PAT. It cannot be no PAT into 1 minus tax rate. Okay, no PAT minus capital charge, this is 301. Where did we get 301? Here we already found out no PAT. No PAT minus capital charge is 222, 3.82. If you assume that the provision is post-tax, post-tax, then what happens? Then you have to arrive at a revised no PAT. Why will you add revised no PAT? Because EBIT is 410. This 410, you subtract 30%. Where did I get EBIT? EBIT is already given, no? They themselves are given EBIT. I'm not doing anything afresh. So from this 410, I subtract the tax rate, which is 30%. I get 287. To this 287, I add back the provision. Just like in the previous case here, I added back the provision, but after tax, I added back the provision. So here, this is pre-tax provision. So I added that back, and on the whole thing, we computed subtracted tax. So here also, The 20 is after tax. So you compute 410 into 70%, 287, and you directly add back the after tax provision, which is 3, which makes it the adjusted NOPAT as 307. Now this is 307. If this is 307, then what is cost of pre-tax, cost of equity, cost of debt? Will this change? These will not change. Cost of equity and cost of debt will not change. Will the weights of equity and debt change? They may change. Right. So what is equity plus reserves currently is 100 plus 800 plus 100, which is 900. Provision for doubtful debts, what you have is 20. So your total invested capital is 920. So weights are again 820 plus 100 and 920. Right. So your again the working comes very, very close to 8.44. Why? Because 920 versus 914, the difference is very, very small. So your back again comes to same 8.44. So what is it again? What is the EVA? EVA is EBIT into 1 minus tax rate minus back into your invested capital. So EBIT is 307, which is your post-tax adjusted NOPAT, adjusted EBIT, or NOPAT, adjusted NOPAT, minus 77.65. What is 77.65? Your capital charge, which is this 920 into your back, which is 8.44. So you get minus 77, you subtract that, you get 229. So you have computed EVA under both the methods, either whether the provision is pre-tax or the provision is post-tax. My suggestion, if they specify, great. If they don't specify, solve both, no nuisance. Okay. And preferably put it in 2 columns. This is pasted in a single column, but you can actually paste it one column beside the other. Right. Question number 29 is done. Then we have 33. Just one sec. I need a water break. Okay, so let's look at question number 33. It's also an interesting question. The following information is given for 3 companies that are identical except for their capital structure. Total invested capital is 1 lakh each. Debt asset is 0.8, 0.5, 0.2. Shares outstanding is 6,100, 8,300, and 10,000. Pre-tax cost of debt is 16%, 13%, and 15%. Different costs of debt. Cost of equity is 26%, 22%, and 20%. Operating income 25,000, 25,000, 25,000. Okay. Tax rate is 35% in all cases. Compare the WACC for each of the company. Compute EVA for each of the company. Based on EVA, which company would be considered best for best investment? If the industry PE ratio is 11 times, estimate the price for each of the above companies and calculate the estimated market cap for each of the companies. It's a computational question and it is simple arithmetic. It is not complicated. I am solving this question purely from a concept perspective so that you understand the concept. What is invested capital? Invested capital is 1 lakh each. What is debts by assets ratio is 0.8, 0.5, 0.2, what they themselves have given. Total debt is obviously what? 1 lakh into 0.8, which is 80,000, 50,000, and 20,000. So balance is equity, 20, 50, and 80. I hope you're seeing this on screen and you're able to work along with me. Debt is 80%, equity 20%. So obviously that is what they've given. What is pre-tax cost of debt is given as 16%. And what is the tax rate? Tax rate is 35%. So for the first company, what is the post-tax cost of debt? 16 into 1 minus 35%, which gives you 10.4. Same way, 8.45 and 9.75. This is the cost of equity. Cost of debt, what is cost of debt? That is cost of debt, I'm sorry. Cost of equity is given as 26, 22, and 20. So you go for 26, 22, and 22, and 22, right? It is not 20. Yeah, it is 22. 26, 22, and 20. Now, what is the weighted average cost of capital? So for each of them, you do cost of debt into weight of debt plus cost of equity into weight of equity. You get 13%, 15%, and 17%. 26, 22, and 20. 9.75% plus 9.75 into 0.2 is equal to m plus 20 into 0.8 is equal to m plus numerator equals 7.9. This is 20 only. That's what I was wondering whether there is a mistake or not. 17.95 is correct. So it's just a typing error. Ignore it. I'll correct it in the revised notes. EBIT is 25,000. So no PAT is EBIT into 1 minus tax rate. We've already got the tax rate as 35%. So you get 16,250, 16,250, 16,250 common for all of them. But capital charge is different. Capital charge is 1 lakh into 13%, 15%, and 17%. So you get the capital charge value as different. What is EBIT? What is EVA? No PAT minus capital charge, which is 16,000 minus 13,000, 16,000 minus 15, 16,000 minus 17. So you get positive no PAT for the first two and higher no PAT for the first company. So what is the first question? Compute WACC, compute EVA. Based on EVA, which company would be considered best investment? So based on EVA, company number A, which is orange, or whatever the name is, orange is considered the best investment. Next is, what is the next part of the question? Next part of the question is, if the industry PE ratio is 11 times, industry PE ratio is 11 times, compute the price of each share. See, you have EBIT. From EBIT, you have to subtract interest. Interest, they've already given you the cost. So debt into a cost of interest, you'll get the interest value. So interest value, you subtract from EBIT, you get EBT, right? From EBT, you subtract tax of 35%, which they themselves give, you get EAT. EAT, you divide by number of shares. They've given the number of shares, you get EPS, 1.3, 1.45, and 1.3, right? This you multiply with 11 times. You get the market price, 14.3, 15.94, and 15.73. So what is the market capitalization? Did they ask market price or market capitalization? Compute the price of each share. We've already computed. And compute the market cap. So for doing market cap, simply multiply with the share count, which is 6,100. You get the market cap, 87, 132, and 157. Even though the last company has very poor EVA, it has highest market cap. For whatever reason. So the EPS is low, but the share count is probably high. No, EPS is also decent. EPS is decent and share count is also very high, 10,000 shares. That's why it has a higher market cap. Okay. So this is question number 33. Then we'll move on to question number 35. What is question number 35? Is it 35? 45? 35. This, I think, is the last question in this particular chapter. This is the last question in this particular chapter. Let us see. Then we'll move to the next chapters. The following data pertains to XYZ Inc. engaged in software consultancy business. So the business is software consultancy. And income is 935 million, EBIT is 180 million, interest on loan is 18. So EBT is 162, tax 35%, and PAT is 105. Now, what is the other data that they've given? Equity shares, 10 million shares of $10 each is 100 million. Reserves 325, loans 180, same 180 of loan and 18 of interest. So interest rate is 10%. Current liability is 180, land and buildings 200, computer software 295, current assets 290, total is 785. They're required to compute EVA and MVA. I took this problem only because I want to show you what is MVA. That's all, nothing fancy. Back is 12% and quoted share price is 50 rupees per $50. Okay, now first is EVA. EVA is what? EBIT into 1 minus tax rate. There are no adjustments. So 180 into 1 minus 35% is 117. Invested capital is equity plus debt. Equity is 425. Debt is 180. So 605. On this, the WACC. They have given WACC. WACC is 12%. So 12%. think it is written as 15, so 12%. So invested capital 605 into 12% is 72.6. What is the capital charge? Capital charge is 72.6. But what is the NOPAT? NOPAT is 117. So 117 minus 72.6 is 44.4, which is EVA. What is MVA formula? MVA is market value minus book value of invested assets. Market value. What is market value? Market value of both equity and debt. Okay. The number of shares is 10. How did I get 10? It is already given as 10 million shares. Everything is in million, by the way. Market price per share is 50. Here, it is already given in the question. Market price per share is 50. So market value of equity is 500. Debt is 180. They themselves are given. So total value is 680. And book value of invested capital. What is invested capital book value? We already found out here, which is 605. So 680 minus 605 is 75. This is the market value added. So it is EVA also is value added. So you're subtracting something. In both the cases, there is a subtraction. In EVA, it is NOPAT minus capital charge. NOPAT is EBIT into 1 minus tax rate. Adjusted EBIT, of course. Capital charge is invested capital into WACC. Of course, again, invested capital is also adjusted. WACC, you'll make all necessary adjustments. WACC is also post-tax. Market value added is market value of equity plus debt minus book value of equity and debt or minus invested capital. Okay. So these are questions in this chapter, business valuation. Now, after doing this, I wanted to take a 5-minute break because my throat is, needs some rest. So just give me 5 minutes and we will come back. I'm putting a timer, a 5-minute timer. You can I'll share that. There is the timer. We are back, and we will start off with the next chapter. In the next chapter, as I said, I do not wish to do M&A. I will do M&A in the last because there are a bunch of problems that we need to solve. So I would rather come and do the IFM chapter where, I'll probably solve 3 or 4 questions. Then also, of course, have a discuss briefly about the theory aspects because we've not spent much time on theory there, and then do the startup chapter and then go back to M&A. M&A will be our last. Right. Time right now, I think we can do for another half an hour and then we'll take the lunch break. So we will start off first with the theory aspects of international financial management chapter. Let's look at that. And please note, there are some new concepts that have come in this particular chapter. So you have to be very careful because there is a very, very high likelihood that questions on this will be asked in the upcoming exams because post the syllabus change, obviously certain new things will be in the syllabus, right? All those new things, there is a very, very high likelihood that they will be tested. Okay. So let us go and look at this. I guess my screen should be visible to you now. Just 1 second. Yes. And my audio is also on, right? Yeah. So great. So let us move back to international financial management chapter. There are about 28 questions. 2 questions have been asked in the past. But this time, given that there is a scope for MCQs, there's scope for small theory questions, we don't know what is the question paper pattern. I strongly suggest that you go through this chapter. And in this chapter, there are 2 important formulae. One is adjusted present value. Second one is your MIRR. Okay. There's a very strong possibility that in one of the upcoming items, they will ask a question on either of those. So we will solve a problem on them also. So don't worry about it. Now, what are the complexities in international capital budgeting? There are a bunch of issues with the international capital budgeting. You are in one country, you are making investment in some other country. There are political problems. There are exchange rate issues. There are interest rate issues. There are a variety of problems that you'll face because of time, distance, culture, so on and so forth. So first one is conversion currencies. Parent cash flows are different from project cash flows. It's a very, very important point because parent cash flows come after tax, whereas project cash flows are cash flows from the project. But when the money is remitted to parent, there could always be issues around additional withholding tax or stuff. So we will solve a problem around that. Then profits remitted to parent are subject to double taxation. There is forex risk, political risk, inflation issues, restrictions on cash distribution to host country, initial investment in host country to benefit from release of block funds. There may be concessions provided by country, the target country. Estimation of terminal value is difficult since the buyers in parent company have divergent views on acquisition of the product. So terminal value is an issue because it is not easy. You are in some other country, the project is in some other country, and you want to sell it in a host country. So they're called as host country and foreign or investing country. Right, host country and investing country. What are the problems and what is the solution? Obviously, first one is forex risk. So you hedge. Okay, you all the from a project perspective you hedge, but from a valuation perspective or from a budgeting perspective, capital budgeting perspective, you forecast the inflation and or forecast the interest rates and arrive at forex rates that reflect the change in interest rate or inflation. They will tell you how you are supposed to do, whether it is based on inflation, because if you remember the forex chapter, we've discussed about interest rate parity, we have discussed about Fisher's theory, we have discussed about PPP. So we discussed about 3 methods. So here, typically we use exchange rate based on purchasing power parity, which is basically inflation. If they don't give inflation, then you can consider interest rates. Okay. Then restrictions imposed on transfer of profits, depreciation, so on and so forth. They can be diluted by application of taxes, that is internal transfer pricing and overhead payments. Problem number 3, block funds. It depends on opportunity cost. Initial investment will be net of any block funds that can be made use of. Parents can release such block funds in country for investment in overseas project. Then such amounts will go to reduce the cost of investment outlay. Then presence of multiple tax regimes. So you try and figure out tax rates, you check, look at their DTA agreements, invest through Mauritius. A lot of people do investment through Mauritius too because it has a favorable DTA. Then what? Next question. What is project versus parent cash flow? How are they different? Explain. This is an important question. The basis on which project shall be evaluated depends on its own cash flow. Cash flows accruing to the parent firm or both. So you may evaluate the project based on project cash flows or parent cash flows or both. The cash flows of the project are different from the cash flows of the parent because of the reason that I said, there may be royalties, there may be taxation issues and all of that. Evaluation of the project is mostly done on parent cash flows. Investment has to be evaluated on the basis of net after tax operating cash flows generated by the project. So invest something, post tax, what is the cash flow? You make all the judgments or all the evaluations based on that. Where should risk be adjusted? Discount rate or cash flows? Ideally, you should adjust it in only one place. People almost always do it in the discount rate, but it is not fair. You should ideally adjust it in the cash flows. You cannot do both places adjustment. Okay, it is not proper to combine. Right, we have discussed that aspect. What is this adjusted present value? Adjusted present value is, it is a way in which you compute the value of the overall project or value of the firm by using this formula, which is initial outflow, normal NPV only, but you split it into three parts. You split it as, because it is accruing to the parent company, what is the outflow for the parent company? Then what is the present value of operating cash flow? Okay. Present value of interest tax shields, present value of interest subsidies. You take all three aspects independently in value. So present value of operating cash flows, or present value of interest tax shield, present value of interest subsidy, and these are hypothetically, theoretically, ideally, logically, practically, they will be positive. From that, you subtract the initial value of investment. Right. So operating cash flows have discounted with cost of equity, interest tax and interest subsidy should be discounted by before tax cost of debt. Please note before tax. Before tax. It is very, very clear. Cost of equity, you typically, you take the cost of equity, but tax is before tax. But debt is before tax. What are FCCBs? Are they a good source of raising money for corporates? This was asked once in the exam. FCCBs are normal bonds issued by companies, but these are issued to people abroad and they have a convertible option. Okay, the bond is convertible to equity at a predetermined price and a specified time. So it has a convertible option with a specified price and specified time. If by the time the conversion option is supposed to be exercised, if the market price of the share is higher than the conversion price, everybody will convert. The market price of the share is lower than the conversion price, everybody will ask for the money back. So that is a key risk. Advantages: flexibility to convert the bond to equity at a price or redeem the bond at the end of a specified period if the price of the share has not met the expectation. So either you want it as equity, you can convert it, provided the price of the share is much, market price of the share on the date of conversion is much, much higher than the conversion price specified in FCCB. Please note, the conversion price is not determined on a later date. It is determined today when the bond is issued. Then minimum fixed interest earning. So basically, for the investor, person who is investing in the fixed bond, there is some interest flow. These are marketable. Then to the companies, what are the advantages? There's high value, the coupon is low. Typically, even though there is interest, the interest is lower, reducing the debt cost. Then it leads to delayed dilution of equity and allows company to avoid any current dilution in EPS, then that a further issuance of equity would cost. So basically, it is a delayed dilution of equity. And where the company has high rate of growth in earnings, the conversion takes place subsequently, the price at which shares can be converted can be higher than the current market price. So today's price, let's say, is 100, conversion price, let's say, is 500, but on the date of conversion, let's say the market price is 1000, then the company, instead of converting the share at today's price, issue price of 100, is converting it at 500, where dilution will be lower. Even though that it is converting at 500 and the market price is 1000, even then that is better than diluting it today when the market price is 100. What are the disadvantages? Interest would be payable in foreign currency, hence more exchange risk. Very, very valid point. And exchange risk even when there is repayment if the conversion does not happen. What are ADRs? This is a very, very important aspect. What are ADRs? We have questions on ADR, GDRs also. ADRs are basically instruments that reflect the value of an equity share, which is underlying those ADR. ADRs are listed in US, GDRs are listed in Luxembourg. ADRs offer US investors a means to gain investment exposure in non-US stocks. So people who are residing in US can invest in their own stock exchange, NYSE. They can't invest in HDFC shares. So HDFC will create an ADR that will mirror the value of HDFC share in India. Those shares it will allot or keep it separately with the depository, and those shares get actually traded as ADRs in NYSE in New York. So in New York, investors can buy HDFC ADRs in NYSE. Okay, without complexities of dealing in forex markets, such receipts must be issued in accordance with the provisions stipulated by Securities and Exchange Commission, which is basically SEBI-like institution in US. ADR is generally created by deposit of securities of non-US company with custodian bank in the country of incorporation. So HDFC issues certain shares. They are kept with the depository and custodian issued through a depository, and the shares are kept with the custodian in India, which acts as a backup for HDFC to issue ADRs in US. Okay, they may be listed on major exchange of New York and may be traded across the world. Okay, over the counter also. What are GDRs? GDRs are same thing, but they are issued in Luxembourg, where globally people can invest. They are very similar to ADR. They are also in dollars, by the way. Except that ADR only lists in a foreign country, only lists shares of foreign country in US, whereas GDR is a listing in Luxembourg exchange. Still, conversion of GDR does not carry any voting right, and they usually represent one or more shares of convertible shares or convertible bonds. Sometimes convertible bonds, but very rarely. Mostly, they represent the shares only of the issuing company. What is the impact of GDR in Indian markets? Because of GDR, to some extent, markets are shifting from Mumbai to Luxembourg. This was slightly old. This is a question. This is ICA material. Everything is dated. Okay. There is arbitrage possibility because GDR may trade a different price. Indian stock may trade a different price. Our stock market is no longer insulated. We are not independent. We are linked to the whole world. Then GDRs or foreign institutional investors placement plus free pricing implies retail investors can no longer expect to make easy money on heavily discounted public issues. So because the company has an HDFC as a company has an opportunity to raise money from abroad, if Indian markets, you and I don't give good pricing, they will go and raise money through ADRs. Right. So company as such can raise shares where they get good pricing so that dilution is less. Now, how are they important? How are GDRs issued? Company issues ordinary shares. These shares are kept with a custodian or depository banks against which they are issued to foreign investors. Very simple. What are the characteristics? The holders participate in economic benefits, though they did not have voting rights. They are settled through CIDL and Euroclear international book entry systems. So the settlement does not happen through Indian exchange. It happens through CIDL and Euroclear. They are listed on Luxembourg. Trading takes place between professional market makers on OTC. They are freely traded. They are marketed globally. They earn income by way of dividends, which are paid in issuer currency, that is in rupees, converted into dollars by depository and paid to investor, and hence exchange risk is with the investor. It's a very, very important point. Exchange risk is with the investor. As far as case of liquidation is concerned, investor may get the GDR cancelled after a cooling period of 45 days. A non-resident holder of GDR may ask the overseas bank to redeem the GDR. In that case, overseas bank shall request the custodian. They will do all the process. It's okay, very simple. No need to read all that. The price of shares of issuing companies prevailing on BSE or NSE on the date of advice of redemption shall be taken as a cost of acquisition of the underlying ordinary share. What are ECBs? Just like ADR, GDR, see, in the international management chapter, you're going to learn about a lot of financial instruments especially in international markets. Euro convertible bonds. These are bonds issued by Indian companies in foreign market with the option to convert them to equity shares. So just like your FCCBs, okay, these bonds carry fixed interest price of equity shares at the time of conversion will fix the premium. The issue of such bond may carry two options, call option or put option. So these basically have call or put. The issue can call the bonds for redemption, or put option, the investor can sell the option back, sell the bond back to the issuer. So these are call and put options. What are other debt routes? You have Euro bonds, which are typically divided into traditional fixed rate bonds, FRNs or convertible bonds. Euro convertible bonds or zero bonds. No interest is payable. These are basically type of our zero coupon bonds. Okay. Then you have bonds with equity warrants. So bonds come with warrants. What is the difference between warrant and a conversion feature? Warrant means in a conversion, bond will go away. In bond plus warrant, bond will exist, and warrant, you have a right to buy. So it is basically an option. It's an option to buy equity. If ever you're asked to value warrants, basically value them just like equity options. And then euro commercial papers. These are short-term money. You can raise short-term kind of money in international markets as well. Syndicated bank loans. These are loans where you raise from multiple banks or a single bank. Things like ECBs and stuff like that, where you can raise at LIBOR. Now LIBOR is not there. It is SONIA, SOFR, a bunch of other things that we studied in which chapter? Interest rate risk management chapter. So right now, these are the benchmarks, not LIBOR. Yankee bonds. What are Yankee bonds? Yankee, if you know, is a term used for Southern America. These bonds are denominated in US dollars and issued in the United States by foreign banks. These bonds are registered with SEC. So HDFC or Tata Power or any of the Indian companies going and issuing a bond in US in dollars is called a Yankee bond. What are samurai bonds? These are denominated in yen and issued in Tokyo by a non-Japanese borrower, just like this. Then you have bulldog bonds, basically seeking to raise capital in pound, bulldog, British bulldog. So it is for British people to raise, for HDFC to raise money in pound terms in Britain. What are masala bonds? India. Masala bonds are rupee denominated bonds. Okay, these three are dollar respective currency denominated bonds. Here, these are rupee denominated bonds. It's a debt instrument issued by an Indian entity in foreign markets to raise money in Indian currency. Please note, bulldog bonds are HDFC raising money from England or Great Britain in pounds, whereas masala is HDFC issuing rupee bonds to someone in Britain. Okay, so that is the key difference. Nobody raises money in India. Okay, that is why we don't have anything called Channa masala or garam masala bonds, because nobody wants to raise money. No foreign investor. So think of Toyota or somebody wanting to raise money in India. A Japanese company does not want to raise money in India. So that is why you don't have an ulta case of somebody raising money in India, which is some masala, garam masala bond, where money is raised in India in rupee terms, but by Toyota of Japan. That doesn't happen because India, we don't have, first of all, we don't have so much money and our investors don't invest in foreign bonds, whereas foreign investors invest in our bonds. What is IFC? This is a new thing. This I'm pretty sure that there'll be at least one MCQ or some kind of a question asked in the exam from this particular topic of GIFT and IFC. Okay. GIFT is International Financial Center, is a financial center that caters to needs of customers outside their own jurisdiction. It is a hub that deals with flow of funds, financial products, and services. It has been, even though it is in own land, but it operates like as if it is a foreign country. They provide flexibility in currency trading, insurance, bank, and other services. They attract foreign investors, benefiting not only the stakeholders, but also the country that is hosting the IFC. So it is basically an IFC, International Financial Center, which is our GIFT city, Gujarat International Financial JFC. This is set up in Gandhinagar. Okay, there are numerous, what are benefits of IFC? Numerous benefits: opportunity for professionals to work, platform for talent entrepreneurs to pursue global opportunities, stops brain drain, bringing back the financial asset, bringing back financial service and transactions presently carried out abroad, trading of complicated financial derivatives. What are constituents of IFC? Highly developed infrastructure, stable political environment, strategic location, quality life, rational regulatory framework, and sustainable economy. What is GIFT City? International Financial Service Center. To compete with its rival IFC in Dubai and Hong Kong, the idea of setting an IFC was started in India. The main motive is to retain in India. Since foreign investors normally are hesitant to get registered in India, GIFT City provides them a separate jurisdiction. Government of India operationalized GIFT City in 2015 April. This is near Gandhinagar in Gujarat. The budget promoted it, so on and so forth. India's first international exchange, India INX, a wholly owned subsidiary of BSE, was inaugurated in 2017. On 5th June 17, NSE also launched its GIFT, launched its trading in GIFT. Initially started trading in derivative products and then currency, interest and other products also added. GIFT IFSC provides very competitive cost of operations with very competitive tax regime. Okay. It is a new financial technology gateway of India. FEMA does not apply. New financial institutions setting business unit in GIFT as they will in GIFT as they will pay reduced taxes as valid for special economic zone can easily offer foreign currency loans to Indian companies abroad and foreign firms. Okay, it operates as if it is like some foreign country only, whereas you and I can go there and work also. Okay, next, what are sovereign funds? This is also a question that is most likely very, very high possibility of getting asked in the exam because it is a new topic. SWF is a state-owned investment fund comprised of money generated by government. So basically, government of India has a lot of money. Assume we have a lot of money, which will go and invest. Now, India does not have a sovereign wealth fund, but there are countries like China, which does it through its oil companies. You have Saudi Arab, Bahrain, Qatar, Kuwait, Malaysia, Singapore, all of these. So you have companies like Temasek, which is Singapore. Then you have Malaysia has Khazana, then you have Abu Dhabi, ADIA Investment Authority. Then you have a bunch of these players who have their country's wealth is put in a fund and it is invested across the world so that the value can grow, so that they can participate in growth outside their geography. India does not have so much money to invest outside. The Indian government especially would rather invest in Indian infrastructure, so on and so forth. Right. So the money generally derived from government by government from country's own surplus. It provides a benefit to country's economy and its citizens. It is created by government. Legal basis on which there are created varies from government to government. Legal base for a sovereign wealth fund can be constitutional law, fiscal law, constitution, company law, or any other law, whatever is required. It can be a company, it can be a fund, it can be anything. What are popular sources? Surplus from state-owned natural resources, bank reserves, foreign currency operations, privatization, or government transfer payments. It can be anything, can be a source. What are common objectives of fund? Protection, stabilization of the budget of the economy from excess volatility, diversify from non-renewable commodity exports. So RDI and all. So just imagine after 30 years, 50 years, let's say there is nobody's using petrol or diesel. All of us get to EV, and that EV is generated from, let's say, nuclear power or whatever it is. Nobody's going to use petrol. Then how do you think Saudi Arabia, Dubai, their countries will survive? Because nobody's buying that petrol. So they have made investments now in variety of these companies. So a lot of Indian startups, these companies, these sovereign wealth funds have invested. Earn better returns than returns on Forex, assist monetary authorities to dissipate unwanted liquidity. If there is too much money in the country, it may create problems. Increase savings for future generation, fund social and economic development, ensuring sustainable long-term growth for target countries and political strategy. So China does this very, very effectively. They invest in Africa, parts of Latin America, and then they there are allegations that they take those countries hostage and in terms of financial hostage, and then they take away the natural resources. That is an allegation, but it again depends on who you are. What are various classifications of SWF? They can be stabilization funds. They can be stabilization fund, they can be savings for future generation, savings for public benefit pension funds, so Canadian pension fund, UK pension fund, US pension funds, they all invest. Reserve investment funds, then strategic development sovereign wealth fund. These are the various varieties of SWF. What are various types of vehicles? You directly have sovereign wealth fund, public pension fund, state-owned enterprises, and sovereign wealth enterprises. Again, these look very similar, but when they ask you, even if you write both together, also no problem. Okay, because the question itself is structured very poorly. The way the institute has given the data is also very poor. What are complexities involved in international financial management? This is an old topic only. The firm has a wider option for financing its current assets. It may choose to avail either locally or globally. However, you'll have issues of tax and interest rates, foreign exchange, political risk, blockage of funds, and rules and regulations. Right. So, international working capital management has three parts. International financial management has three parts: multinational cash management, international inventory management, and international receivables management. What are the complexities and objectives of multinational cash management? So they're asking you specifically only cash management because this is asked in the exam also. Effectively managing and controlling cash resources, attained by improving cash collection disbursement, making an accurate and timely forecast of cash flows, achieving optimum utilization and conservation of funds. It can be reached by making money available as and when needed, minimizing the cash balance and increasing the risk-adjusted return on the funds. Objectives of effective system of cash management are minimize currency exposure, minimize overall cash requirements, minimize transaction costs, minimize country political risk, and take advantage of economies of scale to get better or superior returns. The above objectives are conflicting in nature. For example, minimize transaction costs will conflict with minimizing currency and political exposure requirements. Absolutely. If you want to keep transaction costs low, you should not do more transaction. But if you don't do more transaction, if you have money stuck in a volatile country like Venezuela or someplace, then you have high political risk. Just to avoid transaction costs, you cannot say that I will bear political risk. So it is a trade-off. How does centralized cash management work? In centralized cash management, a group is required to monitor and manage parent subsidiary and inter-subsidiary cash flows. This leads to centralization of information, reports, and movement in investment. So basically, there is think of one person who knows what is going on across the world. Okay, they will manage cash. This helps in maintaining minimum cash balance, manage liquidity, apply various hedging strategies, generate returns, take advantage of netting. So netting is also possible on international scale. You have to take care of FEMA in India, of course, to make maximum utilization of transfer pricing mechanism and exploit currency movement and correlations. What are ways to optimize cash flows? Accelerating cash inflows, managing block funds. You try and make more money faster. If you've invested something, take as much money as out as soon as possible. Block funds. If you have block funds somewhere, use that for some other project investment, right? Leading and lagging. Timing of payment can be adjusted with future currency movements. MNCs accelerate or delay the timing of foreign transactions through adjustment of credit terms. They do the importer applies leading strategy if home currency is depreciating. So if the currency is depreciating, then an importer leading strategy. So I will pay off fast. Exporter applies lagging strategy if home currency is depreciating. So if for an exporter, if home currency, if I'm Infosys, if rupee is depreciating, today rupee is 83, tomorrow it is 90, then I would delay my money coming in. Whereas if I'm Reliance and I'm importing something, then I would make all the payments now so that I can pay lesser amount in rupee terms. Minimizing tax on cash flows through transfer pricing mechanism. So you may have some royalty, you may have some other kind of payments by which, or some corporate overheads by which you minimize the tax. Right, then you have netting. So netting is basically you net what is receivable from me, what is payable from you. So you pool all transactions. In fact, I think we'll see one thing. There are two types of netting: bilateral and multinational netting. Bilateral means I bought from you something, you bought from me something. We'll net both. Multinational means there are multiple companies and then you net. Let us see. See, inter-subsidy. But again, you have to take care of foreign exchange laws. Every country may not allow everything. So India. Let's say there are 5 subsidiaries: India, US, UK, Italy. And India has to pay to USA 40, UK 30, Italy 80, and total of 150. So like that, each country has to pay other countries. How will you do? India has to receive totally 250 and pay 150. How? India has to pay totally 150 and receive 250. So net, India has to receive 100. So like that, you do computation for everybody and then say who has to pay how much. So USA has to pay 20, UK has to pay 20, Italy has to pay 60. All that money will come to India of 100. Right. Then you also invest excess cash. What is this part of? This is part of question. What are ways to optimize cash flow? So when they ask you this question, you need not write full thing, but you can write briefly each point and then explain each bullet point and explain. Investing excess cash flow through a centralized investment management strategy, MNCs can pool excess funds and invest. International inventory management. You have done cash, now inventory. Different entities get large part of inventory from sister units across the world. An international firm normally possesses a bigger stock than EOQ and process known as stockpiling. What is stockpiling? They may ask this question in MCQ. You may have more inventory, more than EOQ, because they may be it is international. There are transportation issues, logistics issues, political issues, exchange rate issues, so on and so forth. This may be because of various political uncertainties or bottleneck or imports on Forex, right? If probability of interruption of supply is very high, the firm may opt for stockpiling, even if it is not justified on account of higher cost. Elaborate receivables management. There are 2 types of credit sales, that inter-firm and intra-firm. Inter-firm sales, basically within the firm, exporter is interested in denominating the transaction in strong currency, while the importer wants to get it denominated in weaker currency. For example, Indian exporter bills in dollars. If rupee is depreciating, exporter may be willing to invoice the transaction weak currency even for a long-term period if it has debt in that currency. So Infosys has debt in dollars. Let's say Infosys, exporter may be willing to, so let's say Infosys has export in dollars, and dollars, for argument's sake, is weak. Then Infosys may bill in dollars because they will get dollars that they will use to repay dollar debt. So if they have a dollar debt, they are okay to receive money in dollars if that currency is depreciating. Okay, intra-firm sales, this is within the firm. The focus is mainly on global allocation of firm's resources. Okay, the product are produced in different countries, established in different countries, and exported to units, leading to large size of receivables. Quick or delayed payments does not affect the firm, or both seller and buyer are from same firm. Though the one having cash surplus will make early payments, while the one having cash crunch will make late payments. So if you have international firm, intra-firm sales within the company, then receivables is not an issue, but then it may be an issue if your money is blocked in a country. Okay, but typically within the firm, if there are receivables, then you will not have much of issues. So friends, I think we have completed all the theory portion of this chapter, International Financial Management. Please remember two things. I just want to show you that MIRR formula also, then we can directly get into the questions when we come back after lunch. International risk, then international financial management. What is the modified internal rate of return, MIRR? It is nth root. Nth root. IRR is always root, no? Nth root of nth root of future value of positive cash flows at reinvestment rate minus present value of negative cash flows at the financing rate. Okay, future value, present value. Future value is anyway in positive, present value is negative, so you do minus PV. Okay, where and whatever the result you get, you subtract 1, where n is project life in years, where n is project life in years. Then we have already seen APV. What is the formula for APV? So now we will come back in 45 minutes or so, and then we will take up the questions that are there in for this particular chapter. I think there are about 3 or 4 questions that I'm going to solve in this particular chapter. So let us go there, and I will put a timer for this as well. Hello, friends. Welcome back. Trust you had a good break. I hope everything that is you want to do lunch and some kind of stretch you have done. I have done mine. So let us come back to the topic that we were discussing: international financial management. We've already completed the briefly the theory part. Now let us go and look at practical problems. I'll not solve too many problems in this chapter because all the chapters, all the questions are very lengthy. In fact, one of the suggestions that I have for students is if you get a question from this chapter, no, if it's a GDR question or if it's a simple question, 2 years or 3 years kind of working, please solve the question. If you get a very lengthy question where there is 5 years of projections and all of that, I'm not saying don't solve it, but I'm saying do it towards the end. Okay, if possible, skip it in choice. So there are three questions I've constantly kept saying always skip in choice. One is this IFM large capital budgeting question. Two is your sharp or index model, where a single index model where they give something very huge working that. Third one is a fate of forward contracts, which specifically takes time. Other than this, finish everything else and then come to them. If possible, leave in choice. If not possible, do them at the last. Leave 3, 4 pages blank and then do them in the last. Because these questions take away time and you make one small mistake, you'll be going round and round. Okay. Fair enough. So let's come back. Let's come back to the discussion what we were in, and let's proceed forward. Just one sec. I'm just. Okay. So let's start off. So we'll solve the first question. First question is, I'll do only one question. I'll not do too many questions in this, as I said. Only one question with the detailed cash flows in working. Right? What is the first question? Very lengthy, as I said. Okay. Perfect Inc., a US-based pharma company, has received an offer from HQ Limited, a company engaged in manufacturing of drugs to cure dengue, or to set up a manufacturing unit in Baddi, HP in India in a joint venture. So US-based company is going to set up something in Himachal Pradesh. Okay, as per the agreement, Perfect Inc. will receive 55% of all revenues plus a royalty at the rate of $0.01, which is 1 cent per bottle. The initial investment will be 200 crores on machinery and factory. The scrap value of machinery is estimated at the end of 5 years to be 5 crores. So 200 minus 5, 195. The machinery is depreciable at 20% net of salvage value in straight line method in 5 years. So 195 by 5, 39. Okay, depreciation is 39. When you read the problem itself, if you come across these numbers like this, you'll feel confident about solving the problem. Initial working capital to the tune of 50 crores shall be required and thereafter 5 crores each year. Okay, it is a 5-year project. You'll put the first year 50, next 4 years you'll put 555. And this is one question that a lot of students have. When you invest working capital, you're investing 555 every year. So what is your total cumulative working capital at the end of 5 years? First year 50, then 5555, 4 5s are 20. So you invested 70 crores, right? So when a project ends, the working capital comes back. Think of as if you're working in a stationery store or a kirana store. I want to show this example because a lot of students have asked me this question in forums or even otherwise in doubts. See, if you invest money in working capital, what is working capital? Basically, inventory and receivables. For a moment, ignore receivables. Just think of it as inventory. So if you invested money in inventory, what does it mean? You purchased 50 crores of inventory, and this is lying with you. Every year, this is increasing by 5. So this becomes 55, then another 5, this becomes 60. What is happening in this inventory? You're maintaining it in a shop. So if you think of yourself as a kirana shop, first year you purchase whatever is the shop expense you did, then you have to purchase inventory of 50 and constantly keep increasing the value of inventory. The final year, it is 70. Let us assume you shut down your kirana shop. On last day, last year, right, when you shut down the kirana shop, what will you do? You will ideally sell off all your inventory. In addition to your normal monthly, weekly, annual sales, whatever is the inventory lying with you, that also will dispose of. So you will dispose of the inventory. So this is an additional inflow. So you will make 5555 as outflows for 5 years. But the last year, you will get an inflow of 70. So basically, in the last year, this 5 outflow will be there and 70 inflow will be there. So the net inflow will actually be 65. Right. So this is something that you should remember. Now let's come back. Any of you any questions, please feel free to ask. No issue. Right. As per government directions, it is estimated the price per bottle will be 7.5 rupees. Okay. So prices predetermined. The production will be 24 crores per bottles per year. In addition to the inflation of respective years, there shall be the price shall increase by 1 rupee per year. In addition to inflation, production cost is 40% of revenues. Applicable tax rate in India is 30 and 35 in US, and there is a DTA between India and US. According to this, tax credit shall be given in US for the tax paid in India. In both the countries, taxes shall be paid in the following year in which profits are arisen. So profit is this year, tax is paid next year. The spot rate is 57 for INR, USD INR. Inflation in India is 6%, expected to decrease by 0.5% every year and 5% in the US. So using the inflation rates, you have to project the forward rates. As per government policy, only 50% of the share can be remitted in the year in which they are realized, and the remaining in the following years. Whatever profits are there, only 50% can be remitted in the current year. Though WACC of Perfect Inc. is 13, due to risky nature of the project, it expects a return of 15%. Determine whether Perfect should invest in project or not from subsidiary point of view. Okay, from subsidiary point of view. So let us see what is the data first. First, you have to input for everything, you need exchange rate. Okay, so 57 is the exchange rate. And India inflation rate is first year 6, year 0, 6, year 1, 6. And then what did they say? Inflation India expected to decrease by every year. So first year it is 6, next year it is 5.5. Why? Because it is decreasing by 0.5 every year. So 5, 5, 4.5, 4, and 3.5. Then inflation in US. What is inflation in US? They themselves have given 5 and they have not said it is decreasing or increasing. So it is stable. Given this, what is the exchange rate? Exchange rate is 57 into spot into, especially if it is a direct, India is direct quote, right? So direct quote into interest rate of domestic currency by interest rate of foreign currency. So 1.06 by 1.05. So you'll get an interest value of, you'll get a foreign exchange rate of 57, 54, 57, 82, 57, 82, and then it keeps decreasing, right? So 1.06 in Indian rate, 1.05 is US rate, 1.055, 1.05, 1.05, 1.05. So like that, the exchange rate is arrived at. So this is the first thing that you should do. Next is, and this because this is used everywhere else, sales volume. What did they say? They very clearly said sales volume is somewhere they mentioned. Production will be 24 crore bottles per year. So production and sales most likely will be same because they have not mentioned anything about it. So sales volume is 24. What is the initial price? 7.5. After that, every year it will grow by 1 rupee. And on top of that, there is a inflation. What is the inflation? Inflation is on this amount. Price per bottle will be 7 and production cost will be so. The price in addition to inflation of respective years shall be increased by 1 each year. So some of you may want to do 7.1 into 1.06 plus 1, or here instead of doing 8.5% into 1.55%, you may want to do 7.5 into 1.55, 1.055 plus 1 rupee. That is also possible, but this looks more reasonable to assume, right? So you can make that assumption also, it is okay. So, but please write very clearly how you are computing the price. Then what is the total revenue? First, the 24 crore bottles into the price. So you will get the revenue. This revenue, out of this, 55% goes to the parent company. So parent company cash flow is this much, but this is in rupees. Please note, all of this is in rupees. See, one more thing you have to note. They've said 24 crore into 7. So everything is in crores. So far, we are still in crores. We have not moved to any other currency. In addition to this, you'll also pay royalty. 24 crore bottles into 1 cent, which is 0.24 crores. 0.24 crores in, again, rupee terms is 13 crores, 13 crores, 13 crores, so on and so forth. So you also have to project the royalty. Then production cost. What is production cost? 40% of whatever is your sale value. So you multiply that by 40%. Your this number, what is this number? 190 into 40%. Right, like that you multiply and arrive at production cost. Then you subtract depreciation. Depreciation, I already told you, 200 minus 5 is 195 into 0.2 or by 5 is equal to 39. Minus depreciation, you get the PBT. This is the first set. Now, there are two ways. The problem in this, or the rather issue in this problem is, entire project cost is, one particular assumption you make is entire project cost is borne by a project cost borne by perfecting AIDS cure only does marketing. So AIDS is not making any investment. But in this problem, there is one fundamental assumption. Tax is on cash flows or profit. That you have to figure out. See, they have not mentioned here what is the tax on. Applicable tax rate is so and so. There is double taxation. Taxes shall be paid in the following year. But I have said taxes on profit or taxes on cash flow. So because if it is on cash flow, you have other remittances also. You have royalty. You have where is that? 55% share of revenues and $1, 1 cent per dollar. On that also there is tax. We don't know. So you have to make an assumption. One scenario, what I've done is where that tax is there even on that. One assumption where tax is not there on that. In exam environment, I'm not sure whether you have the luxury of time to make such two assumptions, but please choose one what you think is fit. Anyway, so now this 37 is PBT. We are so far normal status. That is whatever is the profit. We are still at profit computation stage. So this profit into 30% Indian tax. So you get the Indian tax value. Then you same profit, you compute 35%, 35 or not 33. I don't know why it appeared as 33. You get US tax. Okay. Extra tax is what? So they have to pay in India this tax of 11.33. In US, they have to pay 13.22. In US, they have to pay only 13.22 minus 11.33, which is this. So they only have to pay extra tax. So Indian company PAT is what? Your 37.77 minus 11.33, which is Indian tax. So you have an Indian company PAT separately. Now, the remittance is the profits are remitted half yearly. Please note. What is the PAT? PAT is this much. To that, you add back depreciation. Why are you adding back depreciation? Because you are trying to find out CFAT, cash flow after tax. To PAT, you add back depreciation, you add back the tax also. You put the investment out. Then you make the working capital investment 1, 2, 3, 4, and this entire 470 comes back, which is what I explained to you at the beginning of this problem. Then you added the tax. Why are you again subtracting tax? Because they said this tax is payable only in the next year. So for the first year, tax is payable only in the next year. Same way you pay taxes for next 5 years, which is why the tax of the last year comes in 6th year, which is why we started this the header of this particular cash flow statement, or rather FCF computation, with 6 years, not 5 years, even though project is 5 years. Now, what is the net cash flow? You have 200 of original investment, 50 of working capital. Then you have PAT, depreciation, tax adjustment, and tax, add back the tax and subtract the actual cash flow of tax. So you get the final cash flows from an Indian perspective. On this Indian country's cash flows, this is the number. You remit. What do you remit? You remit. This is, please note, we are still at PAT level. We are not talking about your royalty and 55% share. We're still talking about profit, say cash flow. Okay. Why are we talking that? Because here, if you look at the question, as per policy, only 50% share will be remitted in which they are realized and remaining in the following year. So here, it is not clear whether it is, referring to total revenue or whether it is referring to only the profit element. We have assumed it is referring only to the profit element. So out of this 71.77, half, which is 35.89, is remitted in the current year, balance 35 next year. Out of 68, 34 is remitted current year, 34 next year. Like that, you keep doing all the cash flow after tax. You are referring to cash flows after tax. Then this amount you convert it into exchange rate. What is convert into US dollars with the exchange rate? What is the exchange rate? We have already arrived at exchange rate here. 57.54, 57.82, so on and so forth. You convert it and you convert it in million. Please note, all these amounts are in crores. 250 crores, when you convert it, exchange rate of 57 gets converted to million, 43 million. Just hold on for 1 second. I needed some water. Okay. So you multiply 250 crores. A crore is 7 zeros, whereas a million is 6 zeros. So you convert that crores into millions by multiplying it by 10 and dividing it by the exchange rate. So you get cash flow in USD million. But please note the cash flow that you get in USD million, what happens is on that, the extra tax has to be paid in US. What is extra tax? We already have found out here 1.89, 2.29, 2.69, 3.09, and 3.47. So that you will pay. But that again is in rupee terms. You have to convert that also into dollars. You take again the same exchange rates that are applicable for that year and convert that to dollars and then subtract that. From your overall cash flows that you have arrived at here. From this, you subtract the extra tax, right? Then you will get basically some cash flows. These are the cash flows. Now, with these cash flows here, tax is on profits and not cash flow, and hence working capital investment scrap value are excluded in this working. So tax is only on profits, not on working capital investment and scrap value. So here again, we have not considered on that 55% and the royalty and all of that. All that is independent, right? From this particular project, how much they are getting. So present value of inflow, present value factor at 15% you have, then present value of cash flow. So you basically take whatever are the cash flows that we have arrived at above, and you multiply them with the respect to present value factor, you get an NPV. In this, some of you may want to assume that the taxes the from the project they're also getting 55% cash flows. Those also you might want to add. See, because if you look at this, you look at this, we have not added those amounts. So you might want to assume those amounts and make a computation also. So that is also okay. But see, this is precisely the reason why I don't want you guys to solve these questions, because there are way too many assumptions, whether it is on left-hand side, right-hand side, here, there, up, above, because they're just endless. Everybody can make any kind of assumption. Okay. Then coming to the next part, you solve it the other way around, which is tax is on profits in India and cash flow in US. Okay, so you take that there is cash flow in US. So what is the exchange rate? We have already have figured out. Cash flow to perfect is how much? You've already arrived at 43.8, say 6.84, 11.81. Where is this? 12.14 before the tax. I am taking numbers which are before tax. 12.14, 12.34. Then there is a tax on whatever is the cash flow that is coming in, and then from that you whatever amount is there, from that you subtract the Indian tax. So what happens? So in US, the tax is on cash flow. There also it is 50-50. There also it is next year. I'm sorry. So you actually have tax credit for years like this. Okay. And you then, so basically it is simple working. Your tax in US is 2.13, tax in India is 0.33, which is basically your in dollar terms. You subtract both of them. 1 minute or 1 sec. I'll just show you where the number is. Yes. So you subtract that value and you eventually arrive at cash flow after tax. You subtract from the US tax, you subtract the Indian tax that has already been paid, and you arrive at cash flows after tax. So this cash flows after tax, whatever is the differential between Indian and US, you subtract and you arrive at cash flows after tax. And to that you arrive multiply the present value factor. You multiply the present value factor. Please note there is also seventh year. Why is there a seventh year? Because 50% of the cash flow actually comes in next year, right? So if you have remitted something in fifth year, it will come to them in sixth year. So like that, if you remitted something in sixth year, it will come in seventh year. What is remitted in sixth year? Because the tax in India is paid in the half of it is paid in the next year. So the logic functions in that way. So you basically have cash flows till 7 years, and then you do an NPV. In this case, NPV is 4.16, whereas minus 4.16, whereas in this case, the NPV is 0.58. So I strongly advise not to solve these kind of problems in exam. But again, if you don't have an opportunity, if you don't have a choice, then go ahead. But otherwise, please don't solve. Okay. So moving forward, this is first question. Then the next question that we're going to solve in this chapter is question number 4. I'm not going to solve more problems which are like this, because this is just unnecessary, me reading out some numbers and without, going deep into the problem, right? So I don't want to solve these kind of problems. I would rather solve problems which have some element of, thought built around that rather than pure assumptions and computations, right? So let us get the first one. This is question number 4. Just one second. Right Limited is proposed to expand its operations for which it requires funds of 30 million net of issue expenses, which amount to 4% of the issue. This is a very important type of question. This kind of question has appeared in the recent past. Which amount to 4% of the issue size. It proposed to raise funds through GDR issue. It considers the following factors in pricing the issue. The expected domestic market price of the share is 300, face value of 10 each. 4 shares underlie each GDR. And the underlying shares are priced at 20% discount to the market price. Expected exchange rate is 70 rupees per dollar. You are required to compute the number of GDR to be issued, cost of GDR, and if 20% dividend is expected to pay with a growth rate of 20%. Okay, so this last part is very important before you actually come to the other parts. But anyway, let us see. What is market price of per share? Market price per share is 300. Okay, so this number is already given. How many GDRs make how many shares make a GDR? 4 GDRs. So 4 into 300 is 1200. This is very clear. What is the GDR price? Okay, GDR price is, where did they say? You are required to compute the number of GDR to be issued and cost of GDR to Right Limited. 20% is expected to pay with the growth rate of 20%. So GDR price is 20% of equity market share price. How would they get that? Underlying shares are priced at 20% discount. That is the point. So in GDR is not traded at 1200 rupees, but after a discount of 20%, so it's just 960 rupees. Okay. Exchange rate is 70. So you divide 960 by 70, you get GDR listing price as $13.7142. Now you are required to raise 30 million, but out of which 4% is the flotation cost. Right. So what you do, you use 30 by 0.96. So you will get 31.25. 4% only, no flotation cost. 30 by, which is 31.25, right? It's not 0.98, it is 0.96. Okay, so 31.25. This 31.25 you will have to raise by issuing each GDR at 13.714. So how many GDRs will you issue? You divide one by the other, you will get 2.278 million GDRs. Now, flotation cost is 960. Net of flotation cost, the price that you will realize is 921.6, because that is the price that you will realize. 20% of face value of 10 into 4 shares per GDR. So basically, you are trying to find out dividend. What is dividend? Each share is 300. Dividend is 20 rupees, right? Or no, dividend is, where is it? 20% is expected to be paid. So on each share, 20%. Face value of each share is how much? 10 rupees. 10 rupees by 20% is 2 rupees. But 4 shares together make a GDR. So 8 rupees is the dividend per GDR. Right? 8 rupees is the dividend per GDR. Right? This 8 rupees, using this 8 rupees, you will try and find out the cost of equity. Why are you trying to find out the cost of equity? We'll see. So D1 by P0 plus G. What is D1 by P0? Your dividend, because next year's dividend, they have not mentioned it is current year's dividend or so, because what did they say? The dividend is expected to be paid. Okay, they very clearly said expected to be paid with a growth rate of 20. And where else did they say about dividend? If 20% dividend is expected to be paid. So that is D1, directly D1. So which is why you directly take it as 8. 8 by 960 plus growth rate of 20%, you get 20.83. However, if you don't take it as 960, but you take it as 921, why? Because the market price is not actually 960. You have to adjust for flotation cost also. See, what is the market price here? Here it is 960. But when it comes to the cost of equity, you are having to give a discount. There is an issue expenses of 4. So the price that is quoted in the market is including issue expenses. So you have to reduce that. So these are two ways. If you want to do it in exam, do it in both ways. Otherwise, please state one and make your assumption very, very clear. So in this case, it will be 20.868. So cost of GDR, why we are responding to cost of GDR, because they said you are requested to compute the number of GDRs to be issued and the cost. So cost of equity is basically this. This is the cost of GDR. Cost of GDR gross is this much, net of flotation cost is this much. If you can give this answer, you'll be able to get marks fully for this particular question. Okay, this is second question. Then next question that you want to solve is, I think, question number 10 and 11. Right. So let us go to 10. Let us see what is it. This is again one more question of the first variety. Let us see. This, I think, is an APB question. That is why I want to solve it. XYZ, a company based in India, manufactures very high quality modern furniture and sells them to a small number of retail outlets in India and Nepal. It is facing tough competition. Recent studies on the marketability of the product have clearly indicated that the customers are now more interested in variety and choice than exclusivity and exceptional quality. Since the cost of quality wool in India is very high, the company is reviewing proposal for import of wool in bulk from Nepalese supplier. The estimate of Indian and Nepalese currency cash flows in terms of the proposal is shown below. Net cash flow. Nepalese currency, they've not given Indian rupees, they've just given the exchange rate. In case of Nepalese rupees, 25 million outflow, 2.6, 3.8, 4.1. I think cash flow in millions. And Indian cash flows are 2.8, 4.2, and 4.6. Let us see what it is. The following information is relevant. XYZ evaluates all investment using a discount rate of 9%. All Nepalese customers invoiced in NC. NC cash flows are converted to Indian rupees. The forward rate and discount the same. Acha. So they basically have already converted this 2.6 into 2.869. That is what I was wondering as to what are these two rates. Okay, inflation rates in Nepal are expected to be 9 and 8%. The current exchange rate is 1 rupee is equal to NC 1.6. Assuming that your finance manager calculate the NPV and MIRR. Okay, so this is not a APV problem, this is NPV and MIRR problem. You may use the following values with respect to discount factor of 1%, present value and future value. So these are probably cash flows only. I don't think these are independent cash flows. There's an Nepalese currency cash flow and Indian currency cash flow. Let us see. India inflation is 8, Nepal is 9. So first year, if it is 1.6, then 1.6 into 1.09 by 1.08, like that, 3 years you get exchange rate. Nepalese cash flows in million is this. That you convert it into INR. How will you convert? Divide by 1.6. Why? Because rupee is stronger, so you'll get lesser rupee when you convert it into convert Nepalese currency. So this is the amount. Then you are also getting INR cash flow. Why you are getting INR cash flow? See here. Companies based in India. So it is reviewing proposal for import of wood from bulk from Nepalese supplier. Okay, because it is importing wood from Nepalese suppliers, they expect some cash flows in India, and when they sell, they expect some cash flows in India. Same way, they probably will sell also something in Nepal. Okay, probably that is the reason. Total cash flow numbers, you add both of them, you'll get a value. You discount them at 9%, you'll get a value. NPV is 0.95425. Now, what is it that they've asked? Calculate the NPV and MIRR. So NPV has been a super simple working. There's nothing. What is MIRR? If you remember, I told you the formula also. Nth root of future value of cash flows divided by minus present value of cash flows. Whole thing -1. So first year -15, then 4.47, 6, and 7. What is the reinvestment rate? They have specifically said inflation rates, then they could have given 9% as a reinvestment rate. See, they did not give that. 9% present value factors are these. So reinvestment rates are also 9%. So you have to assume that reinvestment rate and financing rate both are both are same. So what you do is you compute future value. How do you compute future value? You are doing future value of all inflows by minus present value of all outflows. So only inflows are only these. So these three you multiply by the respective future value factor. For the last year, the future value factor is only 1. Please note this. Okay, do not get confused. Where is this? 4.47, 6.5, and 7.09. So for this 4.47, you will multiply it with the 3-year factor. This with the 2-year factor. This is 1-year factor because you are arriving everything with 1. Please don't do the mistake of multiplying this 1, 2, and 3. This is wrong. This is right. Okay. So you multiply the first year cash flow with 3-year present value factor, future value factor. Second year cash flow with 2-year future value factor. Third year cash flow with 1-year present value factor. You get the future value. Right. So all these future values will total up, then divide by the present value of minus present value of in outflows. So you get 19 by 15, whole thing power 3. So if you remember, there was a video that I made on how to compute square root for a term which is not square. How to compute third root, cube root, or fourth root, or things like that is a calculator trick video. It is there in our website. You can go through it, or I think we've uploaded on the YouTube channel also. You can go through that. So then if you do, you get 7.725% as the MIR. Since NPV is negative, they should not proceed further. That's a different thing, but MIRR you've already found out. This is also a very unfair way of questioning, because how will you find out cube root or fourth root using a normal calculator? Right. It is unfortunate, but that is why you will learn that calculator trick. Okay, we have finished 3 questions. Now coming to the last question, which is question number 11. This is adjusted present value. So I mistook the previous one as a APV. This is APV. What is the question? The management of a multinational company TL is engaged in construction of infrastructure project. A proposal to construct toll road in Nepal. All questions Nepal only. Then a consideration. The initial investment will purchase of equipment $250 lakh, USD 250 lakhs. Okay, so that is USD 25 million. Okay. Economic life of the equipment is 10 years. Depreciation of the equipment will be charged on straight line method. EBITDA to be collected from toll road is projected at 33 lakhs per annum for a period of 20 years. To encourage investment, Nepalese government is offering a 15-year term loan of USD 150 lakhs at interest rate of 6%. Interest is to be paid annually, and the loan will be repaid at the end of 15 years in one tranche. The required rate of return for the project is equity financing is 12%, pre-tax cost of debt is 5.6%, and corporate tax rate is 30%. All cash flows will be USD. Ignore inflation. Advise on viability using APV. What is APV? Present value of operating cash flows, which is the present value of operating cash flows plus present value of operating cash flows using cost of equity. Then present value of interest, tax shield on interest, again discounted by pre-tax cost of debt. Then present value of subsidies discounted by pre-tax cost of debt minus your present value of all your outflow. Right. So what is EBITDA? They've given some numbers. Initial investment is 250. Depreciation they've given. EBITDA is 33 lakh for a period of 20 years. So for 20 years, 33 lakhs. What is cost of equity? Same. They themselves have already given us 12%. So present value interest factor for 20 years at 12% is 7.4460. Why? They themselves have given it, boss. I did not do anything. Okay. 7.469. Then you subtract depreciation. Why are you subtracting depreciation? EBITDA is before depreciation. You have to subtract depreciation for what? For PBT. So there is, and please note, we are not going to deduct interest, because interest benefit, we are going to compute the values separately. So you subtract depreciation. Depreciation is how much? Economic life is 10 years. So 250 by 10 is 25. There is no scrap value and all that. It is just directly 25. So 25 cost of equity 12%, present value interest factor for 10 years. You already given 5.65. So you subtract that, you basically get PBT of 105. From PBT, you subtract tax. Tax, what have they given? Tax rate is 30%. So you subtract tax, you get PAT. To this PAT, you add back depreciation, you will get CFAT. Okay. To this, from this CFAT, you subtract the initial investment, you will get NPV from operations after subtracting initial investment, right? So that minus 35 is NPV from operations. Now, value the tax shield and interest subsidies separately. What is subsidy? Yeah, subsidy separately. Loan is how many year loan? 15-year loan, 150 lakhs, interest rate of 6%. So directly take that interest rate of 6%, and pre-tax cost of debt is 5.6. So please note, you're not supposed to take this 6%. You're supposed to take this 5.6, but 5.6 is also pre-tax cost. So you have to, sorry, this is post-tax. I'm sorry, this is post-tax. So you have to arrive at pre-tax, which is what? 5.6 by 1 minus 0.3. That is 5.6 by 0.7. 7 8 is 56. So 8%. You have to discount the these cash flows by the subsidy as well as interest, tax shield on interest by 8%. Right, that is why they have given 8% also. See, they've given 8%. They've not given these 5.6 or 6% anything. They've directly given 8%. It is for that very reason. Now you come down further. What is the interest you pay for first 15 years? You pay what is the interest on 150 lakhs into 6% is equal to 9 lakhs. 9 lakhs is the thing. This 9 lakhs, you take a present value annuity factor at 8% for how many years? 15 years. 8.559. Okay, 8.559. So into 8.559 is 77. And on interest, you have a taxation, which is 30%. So you basically get NPV on tax shield is 23. So this 23, you subtract, to this 23, you add this minus 35, you will basically get minus 11. Now this is minus 11, but to this, you also have to do present value of interest subsidy, because that is also part of the formula. What is interest subsidy? Amount, actual market interest is 8, which is why you're discounting it by 8, but you're getting it at 6. So interest subsidy is 2%. So what is the yearly gain that you make? 2% into 150, which is 3 lakhs. So this 3 lakhs for 15 years at 8.5 and same present value interest factor annuity rate, you get 25 lakh. Okay, so this 25 lakh also you add, then net NPV is 13. So at this point, if interest subsidy is also considered in the project, we are taken as NPV is positive. So NPV has to be computed considering all 3 aspects, that is base, operating, then you have tax shield on interest, then you have the subsidy, present value of subsidy. All 3 you have to consider. And please note, tax shield on interest and subsidy are based on not post. See, I was going to same mistake. Pre-tax cost of debt. If I've said post-tax somewhere, please correct it. Is pre-tax cost of debt. Everywhere else, you divide them by post-tax cost of debt, but here you do this by pre-tax cost of debt, and base is done by cost of equity. It is not WACC. So you're not doing a WACC methodology. You are doing a methodology of both of them, equity and debt separately. Okay, this is question number 11. I think then we have finished this chapter. There are a bunch of other questions that you guys can feel free to go through in the notes that we have given. There are a lot of the solutions are there in entirety. You can solve it on your own. But as I said, once again, I'm repeating, fate of forward contract, single index, sharp single index model, and this kind of questions, which are basically your, international financial management, where they ask you to value a company based on cash flows and all of that, international cash flows and all of that, with withholding, non-withholding, taxation, double taxation, royalty and all of that. Please do them in the last. If possible, avoid, otherwise do them in the last. Okay, now we have finished this. Next, we will go to next chapter, as I said, is I think startup finance. We'll go to startup finance, and towards the end, we will go to MandA. So first, let us go to the startup finance chapter, and this chapter is primarily largely theory, right? Because in this chapter, quite a few questions have been asked in the past. It is not that they've not been asked. This and the first chapter have been favorite. Financial policy and corporate strategy, they both are favorite chapters for examiners in the old syllabus for asking theory questions, right? So please don't discount this chapter. It is a very, very interesting and as well as a chapter with a lot of potential for questions. There are about 17 questions. We will not get into depth of everything, but we will try and see what all we can cover. As I said, it is a purely theory chapter, and also please note, in this particular chapter, there are some new topics that are added, which again have good importance. What is a startup and what are its key characteristics? A startup financing means initial infusion of money needed to turn an idea into a business. Key characteristics of a startup: it is an innovative idea. It has started by entrepreneurs to reach a large market. We scale the business, sell out or die, and usually involves some element of new technology and innovation. What are sources of innovative sources? Please note, this question is about innovative sources. Sources of innovative sources of financing. These are basically your personal credit lines. That is basically an entrepreneur's credit card, family and friends, peer-to-peer lending. Peer-to-peer is there are peer-to-peer platforms where you can go and borrow. Crowdfunding is largely in the nature of grants or people donate. Then you have microloans. Basically, you borrow from a lot of people. Vendor financing, you can take credit from your vendors. Basically, current liabilities, more current liabilities. PO financing, factoring, account receivables, whatever are the account receivables, you get them discounted. Then, of course, personal financing, what I said, personal take a personal loan and put. These are all things that an entrepreneur can initially use to make an investment in his own startup, his or her own startup. Initially, they use their own savings or they take a loan. Personal credit lines, as I said, credit card, family and friends, peer-to-peer, crowdfunding, microloans, vendor financing, PO financing. So if you get a PO from a large B2B customer, you go and tell that to the bank, and bank will give you some money based on the PO to execute the order, and then you can use that particular order to get money and use that money to again do the business, right? And then once the order is satisfied, you repay the loan taken from the bank. Right. What are components of a pitch presentation? So this is a very, very important thing. Pitch deck involves a brief presentation, basically using a PPT to provide a quick overview. You talk about the team, who are the people who are going to be doing this, what is their past, what is their educational background, qualifications, what is the problem that they're trying to solve, what is the solution, because problem and solution, you have to state the problem clearly and you have to state what is your solution. Then what is the sales and marketing stuff? How are you going to reach to customers? What is going to be your marketing strategy? What are the projections and milestones? How will you, what will you achieve? By when will you achieve? How will you achieve? What is the targets? What are the financial metrics? Right. They basically have to give the financials projections as well. Then you get also highlight about who are the other competitors who are there in this space. How are they performing? What is their types? How do you categorize competitors? Then what is the business model? What is it that your core? What is it that you're doing? How are you going to make money? What are your costs? How are you going to make profit? Then financing, it is preferable to, how are you going to talk? How are you going to raise money? How are you, how much is your own contribution? How much is going to be venture capital contribution? How much is it? When will you raise? So you have to talk about all these things. All these things are components of a pitch presentation. Components of a pitch presentation. We can go through that in detail. Right. What is a unicorn? Unicorn is something which has a valuation of at least of $1 billion or more. If it has a valuation more than 10 billion, it is called a decacorn. The word unicorn is because it is very rare. You don't find it. But then we have now hundreds and thousands of unicorns. Unicorn has following features: privately held, valuation reaches $1 billion, emphasis on rarity of success, and common ideas are common features: a new idea, disruptive innovation, consumer focus, and high on technology. So InMobi is the first unicorn in India. India has third largest ecosystem for startups. India had 107 unicorns. I said India itself has 107. Just imagine world over how many unicorns will be there. Then what are various modes of financing, or what is bootstrapping? So modes are bootstrapping, angel investor, venture capital funds. So bootstrapping is where entrepreneur does it on their own. Individually said to be bootstrapping when he or she attempts to found or build a company from personal finances or from operating revenues of the new company. So you generate revenue, repay creditors, and acquire working capital. Basically, it's a circle. Some methods which work through which a startup can bootstrap are trade credit. You can take credit from your debtors. Just hold on one sec. Trade credit is when you give trade credit, basically you are receivables. When you take trade credit, basically means you are buying inventory on credit. Then factoring, you can discount your receivables. Factoring, it reduces the cost for ordination. Then prove fruitful to using this financing method, frees up money that would be locked in receivables. Very useful for raising money and keeping cash flow. You can also do leasing. Instead of incurring a large capital expense, you can lease assets. Then you can raise money through either angel investors or VC investors. Angel investors are people who will invest in you purely based on the idea. They will not get into too much details. They will know you, they will trust you, and then they will give you money. They're the first external investors. Okay, they will not get into too much details. They typically use their own money, like VC, who take care of pooled money. They're also called informal investors. or seed investors or business angels. Some invest through crowdfunding platforms and or some do it directly. VCs basically are institutional investors. They collect money from people, and there's a professional set of VC investors who invest. They finance new and rapidly growing companies. They purchase equity, or in fact, it is CCPS, preference shares, and they assist in development of new products or services and add value to the company through active participation. So they basically are on the board. They keep giving advice, and they give large money. Angel money is usually very small. Okay, at the most 1 million, 2 million. Typically, people raise 5 crores, 6 crores also, but at the most 1 or 2 million. Whereas VC financing is usually, Series A is usually 10, 15 million. Right? What are characteristics of VC? It is very long term, 7 to 10 years. Then no liquidity. So VC does not expect any liquidity initially, at least. So if the company does well, they will have liquidity. Very, very high risk. And their equity participation, that is, they will succeed if you succeed as a startup. What are advantages? It invests long-term equity. They are good business partners. They're able to provide practical advice and assistance because they're only in the business of supporting startups, right? So just one sec. Yeah. So they're in the business of supporting other startups. So hence they will know what are all the issues, how they should do well and all that. They also have contacts. They are capable of providing additional funds. They are they have experience in IPOs and all of that, and they can facilitate also a trade sale if things don't work out. What are various stages of funding? In startup, you have the initial stage where most of the startups die. It's called valley of death. Then over a period of time, your early stage, then you have, later stage, and then IPO. So early stage is when you get angels and family, friends, and fools, as they're called, and seed capital. First stage, early stage is your series A, B, C, D. Then, late stage and mezzanine stage is E and F, and then IPO. Typically after F, you go out for an IPO. In between, you have secondary offerings. And this is the time. So your revenue from nowhere, it actually starts growing up like this. Seed money, low level financing, startup early stage firms that need funding for expenses associated with marketing and product development. First round is based on early sales and manufacturing. Second round, working capital. Third round, mezzanine, expected expansion money for newly profitable company. Fourth round is bridge financing. It is intended to take the company public. What are various stages? Seed money, start money, first stage, second stage, third stage, fourth stage. A number of years, money is locked up, 7 to 10, like that. 3 to 7, 3 to 5, 1 year's risk, very, very high and low here. And what is the money used? Initially, R&D, prototyping, marketing, growing, then market acquisition, and for public issue. What is the VC process? VCs, they don't invest randomly just like that. Just because you ask for money, they won't come and give you. There's a process. There is somebody called deal origination. What this happens is they act either through their analysts keep tracking for companies, or they reach out through intermediaries. They would form intermediate employees about the following steps: sector focus, stages of business, promoter focus, turnover focus. They will look at companies that fit that criteria. Companies would then give a detailed business plan or a pitch, right? So they will do a pitch and sometimes detailed investment plan, sometimes called investment memorandum. Then screening. After sourcing the deal is sent for screening. This is generally carried by committee. So VCs screen all the deals. Then they choose the deal which based on this information memorandum, based on the pitch deck, based on discussions, they figure out whom they want to move forward. To the person whom they want to move forward, the startup they want to move forward with, they issue a term sheet. After the term sheet is issued, which basically contains broad terms, they will do a due diligence. They will do a due diligence, by external bodies, where they would try and verify data, documents, everything. And then they will structure the deal, and the structure is typically as convertible equity. And they will also put in a lot of conditions which say that the founder also has to exit. If the VC exists, the founder cannot sell to anybody. There are a lot of conditions, right? Then the documents are signed, SSA, SSHA, or whatever they're called, shareholders agreement and all of that. And then post-investment, VC has somebody on the board. There is constant MIS sharing. There are milestones. They would constantly monitor the company. They would constantly give feedback to the company. And finally, they will exit, either if the company dies, or they will sell it to third party, or they will do a secondary exit, or there will be an IPO, or there will be a merger, or whatever it is. right? This is broadly the life cycle of what a VC investment process looks like. Then, what are VC funds in India? VC funds started in 70s with government appointed a committee on this. However, it's only after 10 years that the first VC funding was started by IDBI, IFCI, and IFCI. This is a very old school question. I don't know why this kind of stuff is still there in the material. It's a very CA specific CA. I mean, they do all things which are very old and not relevant. Anyway, liberalization improved the entire focus of the entrepreneur ecosystem, and since early 2000s or mid 2000s, this whole sector has got a real fillip, and VC started coming in, and more or less people who worked in the who made money in the dot-com bust, or who made money that particular time, or people who made money in IT industry, they all started investing. How is the structure of VC? So VCs act as either as a trust company or a limited liability partnership. There are various forms in that. The investors in VC are financial institutions, banks, pension funds, and corporations, and HNIs. Structure is domestic funds. So if all the investors in VC, all these financial institutions, bank, pension fund, corporation, are all based in India, let's take example of India, then you will have it is structured as a domestic vehicle. Okay, there is a separate investment advisor that carries duties of asset manager, but funds are put in a pooled in a investment pooled in an investment vehicle. Then choice of entity for pooling vehicles falls between a trust and a company with the trust form due to its operational flexibility. If it's an offshore fund, that offshore structure or unified structure. Offshore structure is where there is a manager probably in India who gives advice, but the funds are resident are in, let's say, in Mauritius or someplace. And because all the investors in it are also outside India, so Mauritius is a better place for everybody to make an investment. Unified structure is when you have both domestic and foreign people. In unified structure, overseas investors pool their assets in offshore vehicles that invest in a locally managed trust, whereas domestic investors directly contribute to the trust. So you have both kind of varieties, right? Then, what is Startup India Initiative? Please note this question has been asked in the immediately previous exam, and not the initiative per se. They gave actually a case where they had asked students to respond if the company or the entity was eligible for benefits under Startup India Initiative. So please be careful. What are the conditions for it being called as a startup? Incorporated in India for up to first 10 years, it is called a startup. It's either a private limited company, partnership, firm, or an LLP. Turnover does not exceed 100 crores and is working towards innovation, development, and improvement of products, a scalable business model with high potential. Entity formed by splitting up or reconstruction of an existing business shall not be considered a startup. Please note. How does this help growth of the startup? So easy finance options such as Mudra scheme, there then a tax holiday under ATIAC. Then there is a SIDBI fund which invests in startups, which invests which invests in VCs. Then you have a DPIIT website where you can go and apply for tax exemption as well as Startup India certificate. Apart from support from government, there are quite a few other reasons. We have a good pool of talent. We have a cost-effective workforce. We have a deep penetration of internet and technology. Very, very, technology-oriented businesses have come up in service sector, both in hubs like Bangalore or NCR or Hyderabad, Chennai, Pune. There's a lot of focus on technology. Then variety of funding options. Earlier, very traditional funding options. Now, a lot more people have money and their variety of funding options. These, in addition to government's active focus on startups, these are underlying reasons why startups have taken off in the country in such a big way. What is the meaning of succession planning? This is a very important question because this is a new topic that is added in the syllabus. It is a process of identifying critical positions within an organization and developing action plans for individuals to assume these positions. So, especially in leadership roles, it is an important priority for family-owned businesses, as most of them are managed by non-family leader, even though the ownership lies with the family. This type of preparation ensures the right people are available for the right jobs today and in years to come. It can also provide liquidity event, which enables the concern to rising employees. Succession planning is a good way for companies to ensure business are fully prepared to promote and advance all employees, not just those who are managements or executive levels. Why is there a need? It is for risk mitigation. Somebody should carry on the business. Cost removal. So if you want to remove CEO or MD for some ethical issue, then whom will you replace? You need to have a plan. Then a talent pipeline, people will retire, people will grow old. You have to get somebody or the other always. Conflict resolution. If the transparent professional management will help reduce the conflicts within families also, families that are owning the business. Then aligning in family-owned businesses, planning helps to align the culture, vision, direction, and values of the business. So you can groom the kind of people that you want. What is a business succession strategy? Evaluate key positions, map the competencies required for the position, identify the competencies of the correct workforce, then bridge leader. Get someone who either will migrate the existing setup to that or get someone who aligns with the values. What are challenges faced in succession planning, specifically with respect to startup? These three, question 15, 16, 17 are very important. Please note, you may get questions on this in the exam. In context of startup, the following challenges are faced in implementing succession planning. Founder mindset might be different from corporate mindset. Very difficult. Having been in a startup, I know founder operates very differently from a corporate. So getting a person to succeed a founder is very difficult. Premature for startups to implement business succession. Certain startups are very early stage, so you can't have succession planning. A 2-year-old company, what succession planning? Then founders are phase of startups. Founders operate in a very different way. Without a founder, the idea doesn't exist, the operation doesn't exist, company doesn't exist. So replacing a founder with a professional who does not have the initially who was not part of the startup is very, very difficult. So these are the questions on startup finance. As I said, very fairly important because 3 or 4 are very new and from new topics, and balance are from are most often asked. Specifically, what are VCs, what is bootstrapping, how does bootstrapping help, what are the various sources of finance for a startup, or what are the contents of pitch presentation. These questions have been asked multiple times. Please write it in bullet point form. Very, very easy. Okay, so now we'll take a break. I think we've been on it for an hour. Next, we are left with M&A chapter. So I will come back to M&A chapter after a break of about 10 odd minutes because I need to give my throat a break. First, we will look at the theory aspects. There are about 26 odd theory questions. Then we'll try and solve as many problems as possible. I've highlighted about 8 to 10 problems. Let us see how many we can solve before we conclude today. Okay, we'll at least solve 4 or 5 for sure. But then depending on what kind of problems, the length and all of that, we'll decide. First, we come back and have a look at the theory questions in this. So just hold on for 1 second. Okay, we'll catch you in 10 minutes. Okay, guys, welcome back. Just one sec. Just one sec, guys. I'm just fixing something. I don't know why this is not appearing. Okay, great. There was some technical issue because of which this happened. Back. Okay, sorry for the trouble. Let's continue. Right. Now we're going to do mergers and acquisitions and corporate restructuring. So this is also again an important chapter. There are not any changes in it from a theory perspective, but there can be good questions that can be asked in the exam. Historically, none have been asked, but I think actually some good quality questions can be asked. Anyway, so what's an acquisition? Acquisitions are situations where one player buys out another to combine the bought entity with itself. It may be in the form of a purchase or a management buyout. Amalgamation is absorption and blending of one by the other. Two or more companies join to form a new company. Demerger is a form of corporate restructuring in which entities' business operations are segregated into more components. So you have one company which is split into more than one. Cross-border merger is you are in India and some other company is in US. You are trying to acquire that company in US, or you are in US and one company is India. US company is planning to acquire an Indian company. It's called cross-border across the international borders. What is the rationale for merger? You basically have synergy, right? So you value of two independent items independently is far lesser than value of them together. Right. What are the reasons for synergy? Increase in efficiency. Basically, a lot of branches and other stuff get eliminated. Economies of scale. You will have bigger orders. Diversification. You basically will have multiple revenue streams. Then taxation. Tax losses can be set off. Then growth. Merger and M&A enables firm to grow at a faster rate. consolidation of production capacities and increasing market power. So you basically have a far more dominant position and you'll be able to get managerial talent. What are the objectives? Horizontal growth to achieve size, vertical growth for improving the efficiency, diversification of the business, mobilizing financial resources by utilizing idle funds, merger of multiple companies with industrial company with a view to increasing cash flow, merging subsidiary withholding to improving cash flow, taking over a shell company for licenses or sometimes even taxes, for nourishing a sick unit in the group that is normally a merger for keeping up the image of the group. So sometimes, let's say Tata Group has one very, sick unit. They probably may merge it with some other Tata Group company just to keep up the image of the group. It's possible. Various forms of merger, horizontal merger, that is people in the same range, let's say Flipkart and Amazon merging. Vertical merger, which is Flipkart, let's say acquiring Swiggy, which they are in the same vertical of e-commerce, but in the different points. One is quick delivery or food delivery, the other one is e-commerce product. Conglomerate merger, unrelated type of business. HDFC Bank acquiring Zomato. I'm just making an example, okay? They're not both are not anything, but just giving an example. Right, their unification of different kinds of business under one flagship. Co-generic is a type of merger where two companies are in the same or related industries or markets but do not offer the same products. Acquired company represents an extension of the product line, market participants, or technology. I think probably Swiggy and Flipkart is a good example of a co-generic merger, whereas for a vertical merger, I think a vertical merger better example would be, Tata Cars and Tata Steel. So Tata Steel is required for cars. So Steel and Tata Motors. Okay, Tata Motors and Tata Steel. They merge, then the benefit for motors is that they can use all the steel capacity in-house. Right. Reverse merger, that is a smaller company acquiring a bigger company, is called reverse merger. Acquisition refers to purchase of controlling interest by one company in another company. It may be in agreement with the majority holder, purchase of new shares, purchase of shares in open market, acquisition by means of cash or shares, and making a buyout to the shareholder, offer to shareholders. When company is acquired by another company, acquiring company has two choices: merge both of them or operate as an independent entity. How do you evaluate gains from merger? Basically, the independent values plus synergy minus transaction cost should be more than the these two values together. So this is basically the net synergy. This should be there. Then what is scheme of amalgamation? A scheme of amalgamation proposal of merger is the heart of the process. It is designed to suit the terms and conditions relevant to the proposal and should take care of any special peculiar features. It is an essential part of the scheme is vesting of all assets. So basically all assets move from transferor to transferee. There are two dates called appointed and effective date. Appointed date refers to when the transaction takes place, but effective dates refers to when it is filed with the ROC. How is financial evaluation done in case of amalgamation? It addresses following issues. Basically, you address following issues: what is the price of the target? What are the principal areas of risk? What are the cash flows? And what is the best way for structuring the acquisition? And then you of course have to arrange for finance. How will you pay? Do you have internal watchers? You have resources? You have to raise money. All of that you will discuss. What are some other takeover tactics? How do you take over a company? There are a bunch of tactics. How do you defend the company? There are another bunch of tactics. What are takeover tactics? Street sweep. This is acquiring all the shares of the company that are listed, that are available, of a listed company that are available in the market. Go and buy. Bear hug. That is, you take the acquiring company threatens to target to make an open offer. So I will make an offer and all your shareholders will sell to me. Strategic alliance, basically disarming the acquirer by offering a partnership and a buyout. The acquirer will assert control from within over a period of time and take over. Brand power. This is you enter into alliance with powerful brands to displace target brands. As a result, buyout will be with weakened capacity. So you, instead of directly attacking, indirectly attack, ally with a competitor so that this guy dies. Okay, then what are defensive taxes? There is something called divestiture. So if somebody is trying to acquire your company, you divest whatever they want to buy. So divest the crown jewels. Crown jewels is involved selling most valuable assets of the company to a third party or spinning off into separate entity. The main goal is defense strategies to make target company less attractive. Poison pill. Basically, whenever anyone tries to acquire, I will make it difficult by diluting the equity share base, or issue a lot of convertible debentures. What is a poison put? Poison put is basically issue bonds that encourage holder to redeem at substantial premium. So I will issue bonds with huge premium. So if a buyer comes in, wants to acquire me, they will also have to pay that debt. Green mail, just like blackmail. It is buying back shares of its own stock from takeover bidder who has already occupied a substantial number of shares in pursuit of a hostile takeover. Management may offer the acquirer for its share a price higher than market price. So if I am acquiring you, you come back and say, give me back my shares, I will pay you this much money, right? So white knight, it's strategy that involves acquisition of target company by strategic partner. So if I am facing problem from you, I will go and ask my friend to help me. They will buy my shares. White square, it is the same as white knight, but it involves selling out shares to a third company who is not interested in takeover. Consequently, the management retains its control over the company. Golden parachute. So whenever there is a merger, I will pay out all my money to all my employees. So then their employees will leave and there is nothing. Then pact-my defense, when company attempts to acquire its potential acquirer when a takeover bid is already been received. So you are trying to acquire me, chalo, I will acquire you. You make an open offer on me, I will make an open offer on you. Okay, that is possible only if both of us have enough money. Otherwise, it's a waste of time. What is reverse merger? Reverse merger is a smaller company gains control of a larger one. There's an important question. Concept has been successfully followed for revival of securities. This type of merger is also known as backdoor listing. Three tests that should be fulfilled before something can be done like this. Assets of transferor are greater than transferee. So that is the assets of the transferor are much, much bigger than the transferee. The bigger unit is merging with the smaller unit. Okay. The equity capital to be issued by transferring the acquisition exceeds original capital issued. So, let's say I'm a small company, I'm acquiring a big company. The big company is way bigger than me, both in asset terms and capital based terms. So when it comes to my existing shareholders, their shareholding will become irrelevant and insignificant because I have to issue huge number. Let's say I have 1,000 shares. I'll have to issue 20 crore shares. These 1,000 fellows will become irrelevant, right? Let's say my assets, I'm a sick unit and my assets are, let's say 1 crore. Now, the company that I am acquiring is 10,000 crore. And for that, I have 10 lakh shares. I have to issue now 10 crore shares. So this 10 lakh shares will become insignificant. My assets will become insignificant. The change of control in the transferring company through introduction of minority holders or a group of holders. What is benefit for the acquiring company? It leads to easy access to the capital market, increased visibility of the company, tax benefits, and easier route to become a public company. You need not do the whole listing process. What is demerger? Demerger means splitting. Involves company selling of divisions or undertakings to another company to create an alternate company. It is used suitable for restructuring, division of family managed business, or sometimes even in case of management buyouts. There are various reasons for the divestment of demerger. To pay attention, core areas, business may not be sufficiently contributing, business being too big, firm may be requiring cash urgently for other investment opportunities. And why are sell side imperatives? That is, why do people suggest for this? Why do people want to do it? For competitor pressure to access new technologies, strong barriers to market entry, poor positioning, inability to achieve critical mass, inability to develop new strategic business unit, possibility to sell at an attractive price, focus on core competencies, and best interest of shareholders. What are different forms of divestitures? Sell off, spin off, split up, equity carve out. These are the four things. What is sell off? Sell off is sale of an asset factory by one entity to another for a purchase consideration. Reasons: it doesn't fit, undervaluing, and can raise cash. This is the reasons. Basically, I'm selling a division to somebody else. Spin off. In this, I make it a separate entity, but my shareholders become that shareholder. So basically, shareholders are same for both, but there are two entities. Reasons: separate identity, avoid takeover attempt, and separate regulated and unregulated business. Split up. What is split up? Breaking the firm into series of spin-offs. So multiple. Entire firm is, so initially there is only ICICI, now ICICI Securities. Assume all the business of ICICI in one thing. Let's say they split up. ICICI Securities, ICICI Bank, ICICI Direct, ICICI something, all companies split up. Imagine they were all together, they're now being split up. Okay, that is called as a split up. Equity carve out can be defined as partial spin off in which company creates its own new subsidiary and subsequently brings out its IPO. So you spin off and then do an IPO for that. Should all be know that parent retains control, part of shares are issued to public. So only some portion is issued to public. What are the reasons for doing the demerger or division of family business? To give control to professional management, hive of unprofitable business, and consolidating core business. What is financial restructuring? Several reasons. It is aimed at reducing claims from various shareholders, realize worth of various properties, utilizing profit on account of appreciation of assets to write off accumulated losses. Where you typically do this for financial restructuring for this. What are types of ownership restructuring? You go private, from public to private. You have a management buyout. The management, that is professional management, wants to buy out the shareholders. And leverage buyout, usually PE funds do this. PE funds, raise a lot of debt against the company with company shares as collateral in the name of the company or something like that. And then using that money, they buy out the shares of the promoters or founders. Or the intention is to improve operational efficiency and then sell it off again. Then equity buyout, that refers to a situation where company buys back its own shares from market. This results in a reduction in equity capital of the company and strengthens the promoter's permission by increasing their stake. What are effects of equity buyback? Obviously, share count reduces, control increases, EPS increases. There's a reduction in the cash balance because cash has gone out. Then ROA and ROE will improve. How can you unlock value through M&A and business restructuring? You can achieve horizontal growth. That is, you can acquire companies in similar vertical and grow. You can do vertical growth. You can diversify business. You can mobilize financial resources. Let's say if you have idle funds, you can use them better. Merger of an export investment or trading company with industrial company, vice versa, will increase cash flows. Shell company will get you licenses and sometimes direct IPO. Need not do an IPO, direct listing. Amalgamation will also be resorted for purpose of nurturing a sick unit. Business restructuring helps company in position the company to be more competitive, survive difficult situations, and take it in an entirely new direction. Right. How are premium and discount arrived in case of M&A deals? Timing is very critical while divesting a business. Economic cycles, stock market cycles, global situations, they all have an impact. During bull phase, there will be a situation there are more buyers but not sellers. Basis for M&A is expectation of several future benefits arising out of synergies. Is advisable to have a range of values, right? So range of values are based on transaction multiple, comparable multiple, discounting cash flow, PE, net asset value, so on. So we are going to talk about this also in the M&A when we solve the problems. What are key steps for successful M&A? Manage pre-acquisition, screen candidates well, eliminate not required candidates, negotiate, execute, and post-merger integration. What is the key reason for failure? Generally overpay, generally overestimate synergy, poor integration, and there are a lot of psychological barriers. Why do companies acquire targets by making payments through share? Because if you believe that your share is overvalued, then you would want to acquire companies through share. Or if you don't have cash, you will acquire companies through shares. Acquire and pay through exchange of shares. The steps involved: estimate their equity value, estimate our own equity value, calculate the number of shares that are required, conduct analysis for pessimistic and optimistic scenarios. Okay. Value of combined business, a function of combined earnings and combined PE. Lower PE can offset the gains of synergy, please note. And higher PE can lead to higher value of business if there is no synergy, even if there is no synergy. What is cross-border? We discussed merger of two companies in two different countries. The reason factors involved in it are globalization, integration of economies, expansion of trade, reforms in various countries, so they become attractive investment opportunities. A lot of places there is privatization. What are SPACs? This is a question that can come up. I think SPACs was there earlier also, if I'm not wrong. But anyway, it's a good question. It's a special purpose company formed only for IPO. In India, it is not allowed, but these kind of companies, they raise money and then they build a business. They go and acquire business. So I have a dummy shell company, which has a lot of money, which has a lot of shareholders. But then what I will do is, I will tell the shareholders I'm going to acquire a company. And then after a year or two, I will go and acquire a company. It's called a blank check company. When SPAC raises required funds through an IPO, the money is held in a trust until predetermined period elapses or a desired acquisition is made. In the event that the planned acquisition is not made, legal format is still pending. PAC is required to return the funds. Okay. However, investors' money invested in SPAC trust to earn a suitable return for up to 2 years could be put to better use elsewhere. Shareholders have the option to redeem their shares if they're not interested in the merger. Finally, if merger is approved by shareholders, is executed in target private company becomes a public entity. The merger of SPAC with target company presents several challenges such as complex accounting, financial reporting. Current framework in India does not support SPAC. ROC is authorized to strike off companies which don't commence their business within a year. IFSA, being regulatory authority for development regulation of financial services, products, and financial institutions in Gujarat, has recently released a consultation paper such as offer size of public, compulsory sponsor, and all of that. So IFSC, what we discussed in International Financial Management, they have come out with a paper on SPAC. Elaborate on needs and rationale for M&A, instant growth, snuffing out competition, acquisition of competence, entry into new markets, access to funds, and tax benefits. Okay, there are variety of questions. A lot of them have similar answers, but please note, you have to study all of them. I mean, I have explained this in depth in the full-fledged class. I can't do this in a marathon or a revision session because it takes a lot of time to explain only theory aspects. So I would rather give you broad idea, broad guidelines, and then you study it on your own. Okay, now that this is over, let us move to the Q&A part, or rather the questions that we have to solve in this particular chapter. This is after the business valuation chapter, right? This is the M&A chapter. Yes, here is the M&A chapter. We have about 1, 2, 3, 4, 5, 6, 7, 8, about 8 to 10 questions are there. We'll see how many we can solve. We'll try and solve as many questions as possible. We'll try and see if we can do this over the next 1 hour or so, and then we can conclude the entire revision sessions. Some of you who are looking for revision sessions of other chapters, we have 2 channels. One is a OneFin final channel. One is OneFin our old channel. In both of them, you have revision sessions specifically for each chapter. We don't have a marathon. In this marathon, we we revised about 8 chapters or so. Balance chapters are available as revision sessions in both the channels. You can go and check them out. Okay, now starting, let us go to question number 3. This particular question is, this PDF is available as part of the description P590. In the description, go and click the file called P590 and you will be able to access this PDF. You can then go through this particular document along with me parallelly. A Limited is studying the possibility of acquisition of B Limited by way of a merger. So A is acquirer, B is target. Following data is available. PAT, equity shares, market price. If merger goes through by exchange of equity shares and the exchange ratio is set according to current market price, what is the new earnings per share? Please note in this chapter, your exchange ratio can be set by value of the shares. Value can be market value. Value can be multiple other values. Can be set by EPS. In some questions, they say EPS. So the swap ratio can be determined by either EPS or market value per share. B Limited wants to be sure that its earning per share is not diminished by merger. What exchange ratio is relevant to achieve that objective? In the world over, nobody bothers about EPS in mergers. The acquirer looks at their EPS should not get diluted. But both of them always look at value. What is the value I am getting? What is the value that I'm paying for? What is the overall increase in value? That is what always matters. And that value comes actually from market price. It does not come from EPS. EPS is a driver of the value. But assuming that my EPS does not fall down or does not increase, that is only a ICA invention. But anyway, we will solve it as the way they've asked for. All right. So let us see. Just one sec. Yeah. So what is the PAT? PAT is 10 lakhs and 3 lakhs. Share count is 2 lakhs and 50,000. So automatically, even in this particular chapter, moment you put a number, start writing down the related numbers to this. Current market price is 75 and 60. So EPS is how much? PAT by number of equity shares, which is 10 lakh by 2 lakh and 3 lakh by 50,000, basically 5 and 6. PE is divide the market price by EPS, you'll get the PE. Exchange ratio as per current market price, 75:60. So one more point in this particular chapter is, if the ratio is 75:60, it means that A is more valuable, right? So shareholders of B will get less shares for 1 share of B. So if I am more valuable, if let's say, we both are exchanging, I have one iPhone and you have, let's say, 2 Samsung. Okay. 2 Samsung probably are equivalent to 1 iPhone. I forget the model. I'm just making an example. Okay. So if the price of my price of my iPhone is 1 lakh and price of each Samsung is 50,000. So for each Samsung phone, you will get only half iPhone. Or for 2 Samsungs, you will get 1 iPhone. Things like that work. So if my exchange ratio is 70, with the current market price is 75:60, 75 is the acquirer, 60 is the target, 60 will get less shares. How much less? the ratio will exactly be ulta. 75:60 is what? Divide by 15, 5:4. So 5:4 is the price ratio. So for every 5 shares of B, they will get 4 shares of A. So the ratio will inverse. So for every 5 shares of B, shareholders will get 4 shares of A. Even though the ratio is 5A and 4B with respect to prices, when the swap comes, swap will be ulta, which is for every 5 shares of A, you will get 4 shares of B. Why? Because B shares are less valuable compared to A shares. So you will get lesser A shares when you give out B shares. What is the existing shares of B? 50,000. Ratio is 5:4. So they will get only 40,000 shares. How? 40,000 is 50,000 into 4 by 5. Now, total shares post the merger is 2 lakh plus 40, 240. Revised PAT. They have not said anything of whether PAT will change. So 13 lakhs as PAT divided by 240. You will get revised EPS as 5.2. Now, what is the point that they are making? The merger goes through by exchange of shares and the exchange ratio is set according to current market price. What is the EPS? So we have computed the EPS. This is the first part of the question. Second part of the question, if B wants to be sure that his EPS is not diminished, what exchange ratio is required? See, what is the EPS ratio? 5:6. Then, if the ratio, if they should get equivalent number of shares, then the ratio should be 5:6, meaning 6 for every 5. Again, 5:6 is the ratio of EPS. So even though B's EPS is high at 6, if they don't want their EPS to be diluted, for every 5 shares of A, every 5 shares of B, they should get 6 shares of A. So the ratio will inverse. 5:6 will inverse as 6:5. So their shares are 50,000. So 50,000 by 5 into 6 will be 60,000. So total share count will be 2,60,000. Why? 60,000 new shares plus 2 lakh old shares is 2,60,000. And you divide the 13 lakhs by 2,60,000, you get EPS as 5. So per share, they're going to EPS is 5. And because they are going to get 5 shares for, because they're going to get 6 shares for every 5 shares. So B shareholder, let's say there are, somebody is holding exactly 5 shares. Old EPS is what? 6, which is they're getting 30. Right. Now B is getting, now in return for these 5 shares, they're getting 6 shares of A. What is new EPS of A is 5. So what is their effective EPS? Effective earnings 30. So the EPS earnings will not change per share if the swap ratio is based on EPS numbers rather than on market price. Okay. This is first question. Let us now go to the second question. Question number 10. Some of these questions are lengthy. Yeah? You should be careful on that. And there was a question very recently in the recent examination that was asked. People got confused for no reason. I mean, there was some mistake in the question, but that mistake was irrelevant to the overall context of what you're supposed to answer. Question 10. A wants to acquire T Limited and has offered a swap ratio of 1.2. That is 0.1 shares for 1:2. That is 0.5 shares for every 1 share of T. Following information is provided. Okay, PAT 18 lakhs, 3.6 lakhs, equity shares 6 and 1.8, EPS 3 and 2, P 10 and 7, market price 30 and 14. Required number of equity shares to be issued by A for acquisition of T based on the following logic. What is EPS after acquisition? EPS of A after acquisition, determine equivalent earning per share of T. What is expected market price of A after if PE remains unchanged, and determine market value of the merged firm. So PAT is 18 plus 3 and 3 is to 3.6 and number of shares is 6 and 18. So you divide, you'll get EPS of 3 and 2. P ratio is 10. So current market price is 30 and 14. Right. Exchange ratio of 0.5 shares of A for every share of T. Right. So number of shares issued in A. How many shares are there in T? 1.8 lakhs. So for 1.8 lakhs, you'll issue 0.9 lakhs. So 90,000. So total share count of A is now 6 lakhs original plus 90,000, which is 6.9 lakhs. So what is post-merger profit? You simply add the profits of both of them, which is 18 lakhs plus 3.6 lakhs is 21.6 lakhs. 21.6 by the new share count 6.9 is basically EPS is 3.13. Now, what is the second question they have asked? What is the EPS of A after acquisition? 3.13. Then what is the third question? Determine equivalent earnings per share. What is equivalent earnings per share? For every share that I have of mine T, I've got 0.5 of A. So now EPS of A is 3.13. So I've got only 0.5 of A. So my EPS is 1.57. What was it before? Before EPS was 2, it has fallen to 1.57. So I am at a disadvantage from an EPS perspective. From a price perspective, let us see. Post-merger EPS is 3.13 and PE multiple is 10. So the price is 31.3. right? So price is 31.3. Number of shares post-merger is 6.9 lakhs. So you do everything, your market capitalization is 216 lakhs. That is, you multiply the share count with the price per share. So that is the answer to the fifth question. Determine market value of the merged firm. Right. Now, from a market value perspective, what has happened? They got for each earlier, their market price was 14, right? But now they got 0.5 shares. Each share is valued at 31.3, which is half of which is 15.8, 15.8, 15.65, right? So now 14 has increased to 15.6. Why? Because for every share I had, I got 0.5 of the other share, and each share is valued at 31.3. So the P increase is compensating now, whereas P on a EPS perspective, I've lost. Then coming to question number 12. XYZ wants to purchase ABC by exchanging 0.7 of its share for each share of ABC. Data is given 10 lakhs, 4 lakhs, 40K, 40 EPS, 28 EPS, 250 and 160 are market prices. Illustrate the impact of merger of on the EPS of both the companies. Okay, so first, shares outstanding is 10 lakhs and 4 lakhs, and EPS is 40 and 28. So PAT is, you have to find out PAT. PAT is not there. So you have to find out PAT 400 and 112, and market price is 250. So market price is 250, and PAT is for, yeah, sorry. What is P ratio? Market price by EPS. What is market price? 250 by EPS of 40. So you basically get 6.25. Same way, 160 divided by 28, you get 5.71. And what is the market capitalization? You divide the share count with the market price, you get the market capitalization. Now I've filled up all the data based on information that they've given. Now let me go and look at impact of merger on EPS of both the companies. Post-merger EPS. What is post-merger EPS? Combined PAT will be 400 plus 112, which is 512. And revised share count. What is revised share count? You will issue 0.7 shares for each share. So how many shares are there? 4 lakh. 4 lakh into 0.7 is 28. So you'll issue 2.8. I'm sorry, 2.8 lakh. Total share count is 10 lakhs of original plus 2.8, which is 12.8. You divide the PAT by share count, you'll get EPS of 40. Now, what is the impact of merger on EPS? Originally, I had one share and I had an EPS of 28. Now I have 0.7 shares whose EPS is 40. So I'm going to get same 28 as EPS. There is no impact. So absolutely no impact on EPS metric, right? Impact on both the companies. On both the companies, there's no impact. My old EPS is also 40 for A, new EPS is also 40. Old EPS was 28 for T, new EPS is 28, equivalent shares, right? Then next question. Management has quoted management of ABC, which is basically the target, I think. Quoted a share exchange ratio of 1:1 for the merger, assuming that PE ratio will remain same after the merger. What will be the gain from merger for ABC? Right. So if you give more shares, then what will happen? There you have to allot 4 lakh shares. 10 plus 4, 14. And PE, your EPS will be 512 minus divide by 14, 36.57. That 36.57, you apply a PE ratio. PE ratio of whom? PE ratio of the acquirer. What is the PE ratio of the acquirer? PE ratio of the acquirer is 6.5. So there is actually a increase in there is definitely going to be a benefit. Let us see. So 36.7 is the EPS. Now pre-merger EPS for shareholder of ABC is equivalent is 36.57 by 28, because earlier they were getting 28, now they got 36.57. So there is an increase of 30.61. Whereas for shareholders of XYZ, there is a decrease of some, for 8% or 9%. Now, what is the next question? What will be the gain loss to shareholders of XYZ? See, that is what I was saying. 36.57 is the share price multiplied by PE of 6.25. So the total value is 228.57. Pre-merger share of ABC is 160. So what is this pre-merger share of ABC? What is the market cap? Market cap is 2000. Sorry, I'm having a Yeah. Pre-merger share price of ABC is 160, but post-merger the price is 228.57. But you see, originally pre-merger the share price was 250, and post-merger it has come down for XYZ, right? So XYZ is actually lost out. Whereas for ABC, they have gained how much? 228 by 160 minus 1. They have gained actually 68%. Whereas XYZ, originally it was 250, it has fallen down to 228. There's a loss of 21 rupees. So they have actually lost 21 rupees on 250, which works out to some 89%. In EPS terms, it was originally 40, that was fallen down to 36. So per share, they've lost as 3.43. So on EPS basis, if shareholders of XYZ should not, then what is the next question? Determine the maximum exchange ratio acceptable to shareholders of XYZ. So XYZ should not lose out on EPS. Then swap ratio is 0.7. Okay, because we've already computed that. But if they do not lose out on price, then you have to compute again. Why? PAT is 512, PE is 6.5. So the market cap is 3,200. Their original market cap was 2,500, which means that you can give to ABC 700. And the price you issue a share, you issue each share that is worth 250. So you basically will issue 7.8 lakh shares. Why? Total value divided by the price per share. You will get 7.8 lakh shares. So basically it means, you have 4 lakh shareholders getting 7.8. So shares that are issued are shares issued in exchange are 2.8 is to 4. So for every 4 shares, you issue 2.8. So basically 0.7 is to 1. So basically what you're basically again saying is, if you do not want to lose out, then you have to do 0.7 is to 1, which was the original quoted number. You can't do anything else, right? So basically same original ratio is what is relevant. Next, coming to question number 14. Money Ratnam, target is Ratnam, and money is acquirer. You have earnings, you have shares outstanding, and you have P ratio. This is also a very similar problem. I don't think we should do it. It's a very, very similar problem. I don't think we should spend time on this. Let us go to the next one. Really sorry. Suddenly caught cold. So let us look at this question, illustration 21. Following information relates to efficient and target company called Healthy. Number of shares, market cap, PE ratio, reserves, promoter holding. Right, out of 500, 4.75, no, not 500. Number of shares is 10 lakhs. Out of 10 lakhs, 4.75 are held by promoter. Out of 7.5 lakhs, 5 lakhs are held by promoter. Both the companies have decided to give a fair deal to the shareholders, and accordingly, swap ratio is, the weights are decided as 40 to 25 to 35. 40%, 25%, 35%, respectively, for earning, book value, and market price. So you have to compute the value of shares for both the companies using these with these weights. Calculate swap ratio and promoter holding after this equation. What is EPS after acquisition? What is expected market price and market cap of after acquisition, assuming PE ratio remains unchanged, and calculate free float market cap of the merged firm. What is the share count? 10 and 7.5. Face value is 10 and market cap is 500 and 750. So price per share is 500 by 10, which is 50. And here it is 100. So PE is 10. So EPS is, you divide the price by PE, you get the EPS of 5 and 20. All right. They have not given you the PAT, but you have worked it, you have arrived at the PAT by looking at the numbers. From market cap, you arrived at the price. From price, you arrived at using the PE ratio, arrived at EPS. Right. Then reserves value is given, reserves per share is given. Then book value, you can find out by adding the face value plus book reserves. Then promoter holding is 47.5 and is 66.67. This is a simple computation you can do. Now, what are they saying? They are saying calculate swap ratio where weights are 40, 25, and 35. So it is very easy to put 40%, 25%, 35%. That is easy. And what is the ratio? Ratios of earnings, book value and market price. So you put earnings, book value and market price. What is the ratio of earnings? EPS 5:20. Book value 40:32. Then market price 50:100. Where is it? 50:100. So you put all of them. So and you simplify the ratio. 1:4, 1:0.8, and 1:2. So what does this mean? 1:4. It means what? For every one share in target, how many shares of acquirer I should see? What is the EPS here? I'll clean this up again. EPS is what? 5 and 20. So target has a better EPS. So for every one share of target, the acquirer has to give 4 shares. Why? 20:5. So you put the number directly 4 here. Same way you compute here 0.8 and 2, and then you give the weights and multiply and arrive at a number, you will get 2.5. So for every one share in the target, acquirer has to give 2.5 shares. Hence, swap ratio is 1:2.5. Right. Then what are we asked next? What is EPS of combined entity and what is expected market price if EPS P ratio doesn't change? Share count is 10 and 7.5. You give this swap ratio. So for every share, 2.5 shares are issued. So 7 into 2.5 is 18.75. So total share count is 28.75. And this is the total share count. What is promoter holding? 4.75 lakh shares. And here it is 66.67 shares. So effective promoter holding is 18.75 into 5 by 7.5, which is basically this 2 by 3, which is 66.75. So you will get 12.75 as promoters of target and 4.75 as promoters of acquired. So total promoter is 17.25. So 17.25 out of 28.75, you basically get a ratio of 60%. Then post-merger PAT. What is post-merger PAT? Post-merger PAT is 200. 200 divided by 28.75, the EPS is 6.96. Then what is the next question? Expected market price. This 6.96 you multiply by the acquirer's PE. Which is 10. So you get 69.6. And what is the post-merger share count? 28.6. So you get a market cap of 28.75 into 69.6. You get a market cap of 2,000 lakhs. And finally, what is free float market cap? Out of this 2,000 lakhs, what is the promoter holding? 60%. So free float is 40%. 40% of 2,000 is 800 lakhs or crores. I don't know, whatever this is. This is lakhs, I think. Lakhs, 800 lakhs. Right. It's a fairly simple problem, but there is some amount of working that is involved. Let us go to the next one, which is 24. There are three or four more questions. We'll wind up after that. Let us see if it is a unique question. We'll do it. Otherwise, if it is a very similar question, we'll ignore it. It's a very similar question. It's a very, very similar question. I don't think we should spend time on this. Right. Let's move to 25. This is an interesting question. T and D are in same industry. Farmer is negotiating for acquisition of the latter. So this is the acquirer. This is the target. Important information on both the companies as per latest financials is given below. T is 12 lakh shares, 6 lakh shares, 10% debentures, 12.5% institutional loan, EBITDA, then market price per share is given. T plans to offer a price of, for E, business as a whole, it will be 7 times EBITDA reduced by debt to be discharged by own shares at market price. E is planning to seek 1 share in T for every 2 shares in E based on market price. Tax rate may be assumed as 30%. Show the following under both alternatives: net consideration, number of shares, EPS, market price, advantages from acquisition. First, basic data. Share count 12 and 6. Face value 10 and 10. Borrowing numbers are given. So EBITDA is also given 400.86. What is this? 400.86 and 115.71. Then interest expense. What is interest expense? They've very clearly given 10% and 12.5%. So you have to compute the interest expense and subtract that from EBITDA. You'll get the PBT. From PBT, they have not given the depreciation number. That's a very weird thing. They should have, because EBITDA is before depreciation. You subtract depreciation also, no? It is logical. So from PBT, you subtract tax, you get PAT. From PAT, you divide by the number of shares, you get EPS, and current market price is already given, so you can work out the PE number. Both of them have a PE of 11. Now, they have said EV by EBITDA multiple of 7. So first method, let us see. T plans to offer 7 times EBITDA, right? So what is EBITDA here? 7 times of EBITDA of 115, which basically makes it 809. From that, you subtract that, you get the value of equity, which is 569. So 569, you want to discharge using own shares. And each share is priced at 220 rupees. So the number of shares that you will issue will be 2.59. 2.59 lakhs for how many shares of E? For 6 lakh shares of E, right? So if that is the case, what is the specific question? Net consideration, number of shares, EPS after acquisition, and other stuff. Okay, let us see. So you'll find out the revised PAT, divide by total share count, revised share count, you'll get the revised EPS, which is 20.56. Then market price. What will be the market price? Same 7 times EBITDA multiple, if you do it on EBITDA basis. So post acquisition EBITDA multiplied by sorry, just one second. Did they say anything about 8.03 being the thing? Post merger is 20.56. This is clear. EBITDA multiple, post merger EBITDA is 516 and post merger EV is 4149. Just one sec. How will we get this 4149? We arrived at it here. That's what I was wondering. Where did we arrive at it? So EBITDA multiple, market capitalization is 260. Then you have debt of 580. So EBITDA EV is 3220. How did I arrive at this market capitalization of 32640? Because we have arrived at a price here. Where is this? Post merger EPS of 20.56. So this 20.56, you multiply by post merger share count. We arrive at market cap here somewhere. 222 into 12 lakhs. Yeah, I think that is the number. 220 into 12. See, 2640. So 2640 is the pre-merger market cap. You have a debt of 580. So total EV is 3220 and EBITDA is 400. So EV by EBITDA is 8.03. This 8.03 you apply to the post-merger EBITDA and arrive at the post-merger EV. Now, and then you subtract debt and you arrive at post-merger market cap and subtract the divide by the share count to get post-merger market price. Now, this is a convoluted way. Why did we do this convoluted way? Because we were not told how to compute. See, expected market price. How will you compute expected market price? Will you use the same 7 times multiple? If you use the same 7 times multiple, you'll get the same answer, which is why we had to use this convoluted way of saying that from pre-merger, you subtract the bunch of things and arrive at a EV by EBITDA multiple, and using that, you compute. If you were to do a PE multiple basis, so post-acquisition PAT is 300, share count is this much, so post-acquisition EPS is 20.56. Multiplied by the post-merger multiple 11, you get 226. So you basically can do either in a EBITDA way or PE multiple way. I actually think that PE multiple way is more clean and clearer. Okay, this is first aspect. Second aspect is they have said they are planning to seek for every one share, seek one share for every two shares in E, right? So they want one for every two. So existing share count is 6 for, they want one for every two. So they want basically three shares for their 3 lakh shares for their 6 lakh shares. So current market price of T Limited is 220 multiplied by 3. So basically the consideration is 660 lakhs, and post acquisition PAT is 300 multiplied by share count, but divided by share count, I'm sorry, you'll get a PAT as 20. So post acquisition 20 into 11, which is the EPS, which is the PE multiple, will give you post acquisition price of 220. So this 220 is the current market price of shares. It is going to be the same thing, which is post merger also, if the ratio is 1:2, because that is the appropriate ratio based on current market price. Why is that the case? What is the current market price? 220 into 110. So that is the appropriate ratio, because at that ratio, nothing will happen to price. On an EPS basis, there may be changes, but on a price basis, there will not be changes. You will be paying the appropriate and correct value. Right. So we have finished now 25. Then a couple more, 32. This is also an interesting question. This is about banks. During audit of weak bank, RBI suggested the bank should merge with another bank or close down. Strong bank has submitted a proposal to merge that bank with itself. The relevant information is as follows. Weak bank, gross NPA 40%, strong bank 5%. CAR for capital adequacy ratio 516. Market price 1296. Trading irregular, regular, assigned weights are given. Now, based on these weights, you have to arrive at a swap ratio, right? So paid up capital is, they've given the data 150 and 500. I think amount is in crores only, no? They're not mentioned. I think it is crores only. Reserves, then deposits, a bunch of information is given. You are required to calculate the swap ratio based on the above weights, ascertain the number of shares to be issued, prepare balance sheet, and calculate post-merger ratios. So paid up capital is 500, 150. Reserves is 5,580, and I put strong here. This is acquirer, this is target. Preliminary expenses, you have to subtract. Net worth, you have to arrive at it. Why am I arriving at net worth? Because one of the ways in which you have to value is book value. Okay, then market price and capital adequacy and gross NPA. We'll arrive at that. Then face value per share is 1010. So share count is, you can arrive at the share count, and book value per share. From net worth, you can arrive at book value per share. You arrive at a number. Then swap ratio computation. Gross NPA 5:40. Again, strong target. CAD 16:5, CMP 96:12, 120:12. So you divide one by the other, you get a ratio, multiply that by the percentage, that will be the swap ratio. So you get a swap ratio of 0.175. So for one share of target, which is a weak bank, you will get 0.175 shares of the strong bank. Pre-merger share count is 15 lakhs, and then you will issue fresh 2.625 shares, because you multiply that by 0.175. Total share count is, and the total paid up capital will be 26.25. Now, why are we computing this? Because they specifically asked, calculate the swap ratio, ascertain the number of shares, prepare balance sheets. For you to prepare balance sheet, you need to know equity value split into face value as well as reserves. So you need to compute that and calculate CAR gross NPA of the strong bank after merger. Equity capital combined is 526, because based on the new shares that we issued. Reserves. How did we get reserves? Net worth of week is 180, and we issued shares of 26.25. So the balance amount is basically the accretion to reserve. So you directly add that as reserve and show the total number. Deposits, you directly add. Other liabilities, you directly add. Cash in bank, balance with other banks, inventory, advances, other assets, everything you add, you will get a total. So here the key thing that you have to remember is you have to make an adjustment for the reserves that get added. How much is the total consideration, total net worth that you are acquiring? Out of that, how much is goes towards equity share capital? How much is going towards the reserves? I'll just highlight it again. Out of 180, 26.25 goes towards equity and 153.75 goes towards reserves. Right. Then what are this thing? CAR 16 and 5 total capital plus reserves is 6,180 and risk weighted assets there is capital by CAR. You'll get this as risk weighted assets. So now revised capital, you have to put the numbers revised capital. What is revised capital? 562.5 plus reserves is revised capital. 6180. On that, you have to compute the revised risk-weighted assets, which is summation of these two by capital adequacy ratio risk-weighted assets. Right. So you get 15%. What was the original capital adequacy ratio? One had 16, other one had 5. Now that has changed to 15. Slightly fallen. Then gross NPA. Originally, advances were 27,000 and 3,500. So you multiply and arrive at actual NPS and sum them, both of them up, and sum the advances as well and recompute gross NPA. It comes to 9.02. What was it earlier? It was 40% for weak bank and 5% for strong bank. So it is 5. This is deteriorated to 9%. Okay. This is illustration number 32. Then we'll go to 43. I think this is a very similar question that we solved. I don't want to solve this. I want to solve a different problem. 47, I think. This will be the last question that we'll solve because I want to solve something that is very different. Buyback wala question. Yes, this is what I want to solve. ABB has surplus cash of 180 lakhs and wants to distribute 50% of it to the equity shareholders. The company decides to buy back equity shares and the company estimates its equity buyback price after repurchase is likely to be 15% above buyback. The buyback route is taken. Other information is as under. Number of equity shares outstanding at present. Face value of rupees 10 is 20 lakhs and current EPS is rupees 5. You are required to calculate the following. Price at which they can be repurchased if market cap should be 400 lakhs after buyback. Number of equity shares to be repurchased and the impact of equity shares repurchase on EPS assuming that net income remains unchanged. So you see what is surplus cash in hand 180. What is the buyback distribution percentage? What do you mean by that? You want to distribute 50% of this 180. So basically you want to buy back using 90 crores. Right. Then what did you say? Current equity shares outstanding is 20 lakhs. Right. Right. And face value is per 10 is 10. So total share capital is about 200 lakhs. And what is current EPS? Current EPS is 5. So current PAT is 100. Now what are they saying? You are required to price the at which equity can be purchased if market capitalization should be 400 after buyback. See, post buyback market capitalization is 400. Then what is pre-buyback market capitalization? Current EPS, number of shares. Do we have PE? No, that is not given. Let us say current price is current market price is P. We don't know what is the current market price. You have to assume work backwards. Post buyback market price will increase by 15%. So P into 1.15. So current market capitalization is 20 lakhs into P. Post buyback market capitalization is equal to you will buy back how many shares? 20 lakh shares minus 9 lakh. It is not 90 lakh. It is minus 90 lakhs rupees by the current price. So this one is pre-buyback share count, which is 20 lakhs. Number of shares bought back, we don't know. How will we know? 90 lakhs is the money you will spend and you will divide by the current price. It is P. So post-buyback market capitalization is 400. So you have to basically form an equation. Post-buyback market capitalization is equal to post-buyback share count, which is 20 lakh minus 90 lakh by P, because there is a reduction in shares, into post buyback price, which is 1.15 P. So you equate this, you get price as 21.89. You get price as 21.89. Now, current market price is 21.89. Now, what are they asking? Price at which equity can be repurchased. We've already told. Number of equity shares that can be repurchased. If you're going to spend 90 lakhs at 21.19, you're going to repurchase 4 lakh shares. That is also very simple. Then impact of equity shares repurchase, assuming that the net income remains unchanged. What is PAT is 100. So PAT divided by revised share count. What is revised share count? 20 lakhs minus 4 lakhs is 15 lakhs. But 100 by 15 is 6.29. Original EPS is 5. So there is an increase of 1.29 rupees, which is basically 25.88% increase in EPS because of the buyback. Okay, I think this is the last question that I've solved. So friends, this concludes the marathon sessions that I've run for 3 days. This is the last chapter that I wanted to do. If you, for further chapters, we already have revision videos that are available on our app. Do go and look out at them. They are available even in our website as well, so you can look out at them. And all these documents are available as part of the description of the video. Okay, my P590, T380, formula sheet, incremental questions, theory questions, practical questions, everything is available as part of my the description of this particular video. Okay, so chalo, we'll wind up today's session. Thanks a lot. All the very best for your upcoming exams, and I wish you all, I wish you all success, grand success, so that you fly out, you clear the exams in flying colors. Okay, chalo, we'll wind up the session here.